How was y'all's lunch?
It was good.
Wonderful. How was you all's?
Good.
Good.
Very, very good. Okay. Pulling everything back up. Okay. So let's go ahead and share. Where is my, there it is. Share. From current slide. Okay, so we did reasonable expectations and now on representations. Okay. It's down. Okay, so representations, what do you guys think?
Those are statements that can be true or are believed to be true.
Okay. Perfect. It's not going. There we go. Okay. In most states, laws dictate that the statements made by the applicant on the insurance application are regarded as representations rather than warranties. What's a warranty?
It's a statement that is true. For example, I know I am Karen Ann Singleton.
Good. Okay. A warranty is something that should be 100% true. Okay. Representations should be true as well, but they're given a little bit more lenience, if that makes sense. So a representation is required to be reasonably accurate according to the applicant's understanding. A representation is deemed fraudulent if it pertains to a significant factor in assessing risk and was made with intentional deceit. So we talked about fraudulent, right? Fraud. So we know what happens. We know what happens there. We know what fraud is. And then again, representations versus warranties. Warranties have to be 100% true. Representations, they have a little bit more leniency. They still should be true, but still have a little bit more leniency. Okay. When applying for a life insurance policy, the applicant states on the application that they do not smoke based on their belief and understanding that they have not smoked consistently in the past 5 years. This statement is considered a representation. If later discovered that the applicant had smoked one cigarette within the past year, it could affect the validity of the policy, but only if the misrepresentation is deemed material to the risk. Okay, so the insurance company will take that and be like, does it matter that they've smoked one cigarette or does it not? Okay. Okay, subrogation. What do you guys think?
I don't know this one.
Okay. Will, any idea here?
Um, no.
No? Okay. So the insurer's right to seek reimbursement from a third party responsible for causing a loss to the insured. Okay, so for example, I get in a car accident. Okay, I get in a car accident and let's say someone hits me and my leg breaks. Okay, I have a broken leg now, someone hit me. The insurance company, I'm going to file a claim. The insurance company is going to pay for that. But they're going to go to a third party. So they're going to go to the other person's insurance and be like, hey, you need to pay for this because this is your fault. Right?
Oh, okay.
Mm-hmm. Okay. So subrogation generally does not apply to life insurance. It is more common in health or property insurance, where the insurer pays for the losses, then seeks reimbursement from a third party responsible for damage or injury. For instance, if a health insurer pays medical bills after an accident caused by another driver, the insurer may use subrogation to recover those costs from the at-fault party's auto insurance. That was the exact same example I used. Let's use another one. What about I go to a theme park. I go to a theme park, I slip and I fall and I break my leg again. Okay. Same leg, it's broken again, poor leg. My insurance is going to pay for that, pay for the medical bills and everything like that. But maybe then they're going to go to the theme park and say, hey, you had a slippery floor and you didn't put, a warning sign out. Can you pay for this?
Okay.
Cool. Okay. So does that make sense?
Yes, it does.
Perfect. All right. If you guys have an idea on how to remember that with using the word, give it a go. Let us hear it. Okay. So unilateral contract. What's a unilateral contract?
It means one contract.
Good. Good. Okay. It means one-sided contract. Refer to agreement in which only one party, the insurer, is obligated to fulfill a legal binding promise. Okay, so only one side is supposed to do that. Okay, a life insurance policy is a unilateral contract where only the insurance company is legally obligated to pay a death benefit benefit to the beneficiary upon the insured's death, provided the premiums have been paid. The policyholder is not legally required to continue paying premiums, but if they stop, the insurer is no longer bound to provide coverage. Good?
Yes.
Perfect. Utmost good faith.
That would be putting forth as correct information as possible in the
Perfect.
utmost good faith.
Yeah, that's exactly right. It's exactly what it says. It has to do with the belief that both the policyholder and the insurer need to know all the material fact and relevant information, and are thus obligated to disclose this information to each other, ensuring that neither party withholds important details that could affect the agreement. Okay. So they're pretty much saying, I think that you're telling me the truth about everything. Okay. That's the hope. That's the utmost good faith. I have the utmost good faith in you that you're telling me the truth.
And really that could be tied into reasonable expectations.
There we go. Perfect. Perfect correlation there. Reasonable expectation. Tell me what reasonable expectation is.
It's what we're expecting. I'm expecting the insurance company to cover me, and they're expecting me to pay my premiums.
That's exactly right. They're expecting me to tell the truth. I'm expecting them to tell the truth. You're exactly right. Okay, so when applying for a life insurance policy, the policyholder discloses all relevant medical history, such as pre-existing conditions or surgeries, to the insurer. In return, the insurer provides accurate details about the policy's terms, including any exclusions or limitations. Both parties rely on utmost good faith to ensure the contract is based on complete and truthful information. Okay, a valued contract. What is a valued contract?
Ugh. I didn't know that. I'm learning.
Okay, good. Good. I'm glad you're learning. Okay, so a type of insurance contract that pays a specified amount regardless of the actual loss incurred. Okay, doesn't matter how you die, I'm paying you this amount. Doesn't matter how you lost your leg, I'm paying you this amount for your leg. Okay, doesn't matter what happened, I'm paying you the same amount. So a life insurance policy pays the face value of a policy upon the death of the insured, regardless of any other financial factors. Doesn't matter if you're rich, poor, it doesn't matter any other exclusions that people may think they make. Doesn't matter. We're paying you this if you have the policy. Good?
Excellent. Thank you.
Perfect. Avoidable contract.
Yeah, I saw this in the course and I really didn't understand it.
Okay, let's talk about it. Will, any idea?
Is that a contract that can be voided once it's found out that the information was misrepresented and false?
Yeah,
As in case of somebody saying that they're not a smoker and it's found out that they are, and that's what they had a pre-existing condition that they didn't disclose, and then tried to make it seem like it all of a sudden just happened by not disclosing it in advance.
perfect. That's perfect. Yeah. So essentially, a contract that can be legally voided by one of the parties under certain conditions acceptable to the court. So you mentioned a very good example. So It's essentially someone says something wrong, misrepresentation somehow, some way, and they bring it to court, and that is a valid reason why the contract can be voided. Then okay, so then it's called a voidable contract. But it can also happen on the other side, okay? Let's say we had a policy that um, that we thought was created in a fraudulent way. So we thought that we bought the policy, but we were maybe misguided, okay, because the insurance agent wanted to make more money, okay, so it told you to go with this policy instead of the other one. I can take that to court and I can say, hey, this policy I bought, but I was under the assumption of this, that, and the other that the agent told me, and it's not true. Okay. Therefore, I could possibly have a voidable contract. I could possibly void the contract. Does that make sense?
Yes.
Cool. So it can happen on either side. So a life insurance policy may be considered voidable, maybe a voidable contract if the policyholder is found to have a misrepresentation of their health status during the application process, which is what you said, Will. And for instance, if the insured claimed to be a non-smoker but was actually a smoker, the insurer may choose to void the contract and deny the death benefit due to his material misrepresentation. All right. Waiver. What's a waiver?
That's something that's signed where you're relinquishing, like, if I die this way, then I don't expect to have a death benefit paid out. I'm waiving, or even waiving a certain type of coverage because it adds more to the premium and you don't think you're going to fall under that category.
Great. So the voluntary relinquishment of a known right, legal claim, or benefit. This can involve opting out of coverage, like waiving a mandatory health insurance benefit, or relinquishing the right to pursue a claim against a third party in the event of a loss. Okay, so if I'm waiving something, I'm pretending like it's not there. Okay, if I'm waiving your fee, you don't have to pay, right? So if I'm waiving something, I don't have to charge for it. Okay, so essentially, you're giving up one of your rights.
Mm-hmm.
Cool. So a life insurance company may issue a waiver of premium rider, which is what we talked about before, which allows the policyholder to stop paying premiums if they become disabled. By offering this rider, the insurer waives its right to collect future premiums while keeping the policy in force. Okay, Karen, what is it if it's just for kids?
What is what? What did you say?
What is it? What is the rider? What is the rider called that is waiving the premium if a parent dies? Waiving the
The payer rider.
payer rider. Something
Yes.
I learned today too. Payer specifically for children. Okay. Waiving the premium, waiver of premium can be for an adult if they're disabled. Good. We're on the same page.
Yes, ma'am.
Cool. Warranty. What is warranty?
That's a statement that is most and certainly fact true.
Good. In most states, laws indicate that statements made by the applicant on an insurance application are treated as representations rather than warranties. A warranty must be completely accurate and true in every detail. Unlike representation, a breach of warranty can void an insurance policy regardless of the materiality of the breach or its impact on the loss. Okay, so essentially, like we were saying before, warranties 100% have to be right in every way, shape, or form. Okay, a representation, you have a little bit of leeway there.
Correct. Yes.
Good. Okay. In a business key person life insurance policy, the company might warrant that the insured key person does not engage in hazardous activities such as skydiving or mountain climbing. If this warranty is proven false, the insurer could void the policy because the specific activity significantly impacts the risks. The risk. Okay, I just realized that my name is Justin on here, and that's not right.
When I came back, I said, oh, I wonder did they switch?
Yeah, no. Still me, still me.
No, it would have been fine either way. That was just a question, but yeah, I did notice that. That's
I
just
think
my eyes. That's all.
no, you're good. I like it. I like that you pay attention to detail. Um, but yeah, Jules. Jules, not Justin.
Right. We're enjoying you. You're doing an excellent job. Seriously, you really are.
Good. Okay, I'm glad. I'm really, really glad. Okay, so let's see. And it's time for a Kahoot. Okay, so we can either try it again or do what we did last time and just share screen and answer them together.
I'd
What would
rather just share screen and answer.
share screen?
Yeah, that would seem to work better.
Perfect. Okay, let me go ahead and pull it up and then we'll go
Is it
from
just Will and I?
It's just yeah.
I mean, it
Oh,
was just me and you from the get-go. I mean, we were the only ones answering questions.
Will, stop being so bad. Will, you're gonna.
I mean, you kept saying you didn't want to answer all of them, and I was like, well, I don't want to answer all of them either. When is somebody else going to pipe up and say something?
I'm very lucky to have the two of you in this and making it
We're
more
happy
fun.
that you're here.
Yeah.
We are. We're having. I'm
Oh,
having
hey,
fun. You're making this fun. It's not dry and boring.
Good. I'm
right?
glad that was my hope. I'm really happy because I know that going over definitions for 8 hours can be a little tough. So try to make it as exciting as you can. Um, okay. So let me share this screen. Okay, can you guys see this screen now?
Yes, ma'am.
Yeah.
Okay. Let's see. Okay, so get ready to start. Like I'm in the way. How do I start? Where's my little start button? I'm still having issues with it. Oh, there it is. All right, here we go. Quiz. A contract of blank is created by one party and the applicant must take it or leave it.
Adhesion.
Adhesion. Look, y'all didn't even need to. Oh, wait, I have to click the next button.
Mhm.
Oh, wait, here's the music. Let me turn the music off. Okay. Adhesion. You're exactly right. Adhesion is correct. Okay. True or false? Let's see. The agent represents both themselves and the client during the application process.
I'd say false because
False?
I believe you're representing yourself as the producer and the insurance company.
I say
Perfect.
false too because the agent represents the right. He said it right. The company.
Yeah.
Right. So he's yeah, exactly. I agree, William. False.
All
Good.
right.
Good. No, I'm glad. You guys are great. So that's exactly right, William. You guys both said it. It's the agent represents the insurance company and themselves. Okay. Perfect. Or the brokerage, as you can say. A type of contract that the insurer is obligated to fulfill a legal binding promise.
Indemnity. And I'm gonna tell you why I'm saying this, because really this could be a trick question. It could be, but I don't see one-sided. So that's why I'm not saying unilateral and I'm not pronouncing it correctly. But the reason I'm saying indemnity is because the contract's supposed to restore everybody whole.
Okay. I hear you. I hear what you're saying. Will, what do you think? I know the answer's up there.
Um,
What is your thought process
Oh,
here?
it is unilateral. Okay. I just saw the answer.
yeah, I didn't know.
Okay, so you're right. This is a confusing question. So a type of contract that the insurer is obligated to fulfill, a legal binding process. Unilateral, you're right. It could be a few. I wouldn't fault you for answering this wrong because this is a very broad definition for unilateral. What should it say? I know, Karen, you kind of already touched on this, but what should it say to make it specific to unilateral?
One-sided.
One-sided. Exactly. Perfect. Does anyone remember indemnity? What that is?
To restore the insurer to the wholeness before the loss.
Yeah, to insure. So you reach age 100 and you get to that point, then the insurance company will pay back all of your premiums if you're talking about life insurance. Okay? They're restoring you back to where you were before even saying hi to them. Okay. An insurer's right to seek reimbursement from a third party responsible for causing a loss.
Subrogation.
Subrogation.
Subrogation?
Yes.
Yay, you guys got it. Do you guys want to explain it anymore, or you guys feel pretty good about this?
We feel good. Both of you all gave great examples about that because I just learned that one. So yeah, I feel good about that one.
Good.
I'm in a car accident. I have AAA. And even though the medical bills may pay, they still may need a third party to take care of it, my medical bills.
Right. Or they're gonna ask the other person, maybe the person that hit you.
Exactly. That's the part there, the other person. We need your insurance to pay my medical bills.
Mm-hmm. Good. Okay. On to the next, true or false. Estoppel is a legal principle that prevents a party from going back on their previous action.
True.
True.
True? Good.
Yeah.
Good. Any thoughts or comments on that one?
Not for me.
No.
Okay. The authority given to an agent by the insurer outlined in the contract.
Expressed.
What do you think, Will?
Yeah, I think it's expressed.
Perfect. Express authority. Okay, the authority given to an agent. So it's in 30, given to the agent by the insurer, outlined in the contract. That's the express authority. Indemnity contracts aim to restore most of the financial losses. Careful with this one.
Yeah, I know because it has the word most. I'm gonna say
No.
false.
Good. I'm glad you caught that. False. It's supposed to restore them back to their original state before anything happened. Okay, any previous verbal statements not included in a signed and written contract can be subjected to
Avoidable contract.
No contract.
voidable contract.
Oh.
All that parole evidence. I didn't even like that when I was studying it.
I know. Do you guys remember the definition we talked about for parole evidence?
Oh gosh, let me think for a second.
Yeah, I think it's along the lines of that once it's written in, it can't be verbally changed. It has to be written and it has to be put in writing form and requested that way.
That's exactly right. So everything written down is what's included in the document, but any oral statement, whether that was before the contract was made or after, they're not included. It's like they just didn't even happen. Because then it's her word against mine, right?
Okay, I'm writing that definition down so I don't forget it. Okay.
So once the party puts it into writing, any previous verbal statements are not included.
So let me ask you this regarding the voidable. Can that be an oral statement that can't be changed? Because that's where I get a little confused. I understand now that the parole evidence rule is the written. Because to me, go ahead, I'm listening.
No, go ahead.
I'm just trying to make the distinction. This
Okay.
one, parole evidence, meaning that it is the parole evidence rule that it is written, meaning that what's this in writing cannot be changed, correct?
Mm-hmm.
So the
Can
voidable contract,
so parole, so let me change that a little bit. Parole evidence rule, once it's in writing, it cannot be changed by any oral statements, any previous or post oral statements.
okay.
Okay. So a voidable contract is one that they found misrepresentation and they take it to court and they say, hey, I don't think that, this was right. And if the court, if under the law, it's said to be a reasonable reason, then it can become a voidable contract where the contract is voided. Okay. Or the other side of that, where the person feels like they were misrepresented or feels like they were, maybe misguided or something like that. So a voidable contract is a contract that can be void. Parole evidence rule is just saying, once the statements are down on paper, no oral statements can be used to alter the statements on paper.
So to get it clear in my mind,
Mhm.
it's like a rule, like a statute, meaning the parole evidence rule.
Yeah.
Okay.
Yeah. It's a
That
rule.
helps me better. Okay.
Yeah. It's a rule saying, hey, once we have it written down, anything that you say doesn't matter. We look at what's written down. A voidable contract is, hey, I think something's fishy here. I don't really like it. I'm not doing this contract. The contract is voided.
Understood. Thank you.
Mhm. Okay. So, true or false, policy rider or endorsements modify original policy terms.
True.
True.
True. Good. Perfect. They can add or take away, remember?
Yes.
True or false? Okay. Let's see. Okay, so this is another true and false. Okay, so aleatory contracts may have a significant imbalance in paid premiums to what is paid out. Look, can you guys see it? Is this covering it for you guys too? Move this down here.
No, I can see
No,
the
I can see
question.
it.
You guys can see it. Okay. So may have significant imbalance in paid premiums to what is paid out in an uncertain event. This one's confusing.
It is because aleatory means you have to take it or leave it,
Okay.
whatever's in the contract. Aleatory contracts may have a significant imbalance in paid premiums to what is paid out in an uncertain event.
So aleatory contracts, remember adhesion is take it or leave it.
Oh, I got it mixed up. Okay.
Mhm.
You're right. So let me explain this. Well, I don't mean to take over, but I'm just thinking this out. May have significant imbalance. That is true because if that's the case, aleatory is an unequal value.
There we go.
Yes. Okay.
Yeah.
Right. Okay. So since that is the case, let me reread the question again. So that is true. That's a true statement.
Perfect. Can
Yeah.
I get an example from one of you guys?
You gave the example earlier of the premiums paid on an insurance policy are less than the benefit that would be paid out to a beneficiary upon your death. So there's an unequal balance between how much is paid into the policy to keep it active and enforceable, and then what is paid out.
Perfect. Perfect. Yeah. So that's a perfect example. So let's say I get a whole life insurance policy and I die 3 months later. And the insurance company has to pay my $500,000 benefit to my beneficiary. That is a very it was a very big imbalance, right? Because I didn't pay that much because I only paid 3 months of premiums. I only paid 3 premiums. And depending on when my premium payments are, right? Because you can have monthly, semi-annually, annually. but that's a very big imbalance. Okay, so aleatory is an imbalance in what is paid. Can you guys think of a way to remember that?
Well, for me, I just have to commit it to memory because as you can see, I can get it mixed up. But if I see unequal value, I know that's aleatory. Now, I don't know if they're going to have that way in the test. And if I see take it or leave it, I know that's adhesion.
Good.
That's to me is the only way that I'm going to be able to remember. I just have to commit it to memory.
Karen, too.
Yeah. Yeah. Pretty much the same way.
Okay. Let me see. Um,
And the way that this is worded, if I really knew the definition, that is the answer because it's unequal. If I really knew it, had committed it to memory and balance, it's not a balance, it's not equal.
Yeah. So you can also remember aleatory, a lottery. Okay. In a lottery, you don't know if you're gonna get the really big benefit or not. You could pay the $5 for the little, lotto card and fill it out and everything, or scratch it off, whatever you're doing. And you could win $1 million. Okay. Or you could pay the $5 and win nothing. So
Correct.
aleatory, unequal imbalance. A lottery, you don't know.
Correct.
Okay. Let's go to the next one. Oh, I think that's it. I guess that was number 10. Okay, perfect. So that was number
So
10.
I do have a question though, if you don't mind sharing. What was your experience like when you took the test?
Okay. So my experience was a little bit different, I have to say. I had left medical school and I was figuring out what the heck to do. And my parents were like, hey, you're on school, you gotta go, you gotta figure out something, right? I was saying my prayers. I don't know if you guys have, where you guys are with faith or whatever else, doesn't matter. But I was saying my prayers. I'm like, okay, God, where do you want me to be? And I ran into this really nice lady named Miss Wanda, and she started talking to me. And she, I get in the elevator with her, and she's like, you know what? I really like you. I'm taking you back upstairs. And so we go back upstairs, and I talk to this guy named Nolan, and we start talking. He's like, you know what? Just go get your license and see what happens. Like, you got nothing to lose. I was like, you're right. And I would have never in a million years gotten my license if it wasn't for that experience right there. So I essentially had 2 weeks to study and take it. But 1 week I was moving, and the second week I was studying, and I took the exam on Friday. So my whole experience was very short and condensed and very rushed. But I have to say my 8 to 10 hours a day of studying in medical school really paid off there because I knew how to get it done and get it done quickly. So when you get in the testing center, they pat you down, they scan your glasses, they do that whole thing. I was very used to it being in there for a bunch of tests for medical school, so I kind of knew the whole process. And they sit you down and they're like, okay, you'll know your score at the end. Okay, so I took the exam. I started, this was so bad, but they give you a little piece of paper and they say, okay, use it for whatever. And I said, okay, I'm going to make a little slash every time I'm unsure about an answer. Okay, so I made a little slash. By question 10, I had made 5 slashes. And I said, okay, I'm not going to make any more slashes. That's not good. I was very, very nervous about the exam just because I know most people study a little bit more than a week. So I was like, a little bit stressed out about it. So I made 5 slashes on the first 10 questions. And I finished the exam, and the guy comes in. I had no score yet. Okay. The guy comes in. He is like, okay. And he turns on, he goes very slow. This is old man. I mean, very sweet. I was dying. I mean, I'm telling you, like, he's like slowly turning off the computer, wiping everything down, taking his time, pushing in the chair. And I was like, oh my gosh, like, and did I pass? Like, I couldn't came in here with the news. And, so we walk out of the testing room, and I see this lady that's sitting at the front desk, and she slides this little piece of paper across the table. And then she's like, okay, you can look at it. And I was like, right here in front of you guys? And they're just like both looking at me. And I flip it over and it tells you your score and if you pass and everything. So that was my
Wonderful.
experience. I know that it's a little bit different for everyone. But I will say in the whole studying process, what helped me the most was just going through questions. And that's what
Yeah.
helped me in medical school too. I mean, you learn test taking is a strategy.
Hmm.
Test taking is more than just knowing the information, it's knowing how to take that specific test and knowing how they ask those questions. So I feel like more than anything, you can spend hours and hours and hours on learning the information, but honestly, someone who sits there and just does questions for that same amount of hours
Hmm.
might do even a little bit better, in my opinion.
No,
But
you're right. It's true. And
yeah,
that's why I like Justin's course. Those quizzes help a lot. They help a lot. They help so much.
good, 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 good. Yeah, definitely utilize them. That's what helped me the most on my exam.
The only problem I had was when I got to chapter 4. And the first part, I was
It was
fine.
long.
There was like 50 something slides. But part 2 was monstrous. It was over like 90 some slides. I think in the future they should split chapter 4 because there is so much information to cover in that chapter, at least into 3 modules. I think
Okay,
it would
I'll write that
probably
down.
help people a little bit better because I know like I was stressing. Like pretty much my average score for all the chapters was like an 83, but that one I ended up having to take it twice because what I thought I had remembered was like I just deer in the headlights on some of the questions was just like I don't even know if I read this part of the chapter because I lost track with how many slides there were.
Yeah. Okay, I hear you. I'll talk to Justin about that and see. I know he loves, feedback. Any feedback you guys can give, even if he sends an email, I know he'll take into consideration. We'll talk about it. So good. Okay. Well, other than that, how was the course going for y'all?
It was going good. I had already done I did all the chapters, I completed it, and I've done 2 of my 4 practice tests.
Okay.
And so far I've been doing okay. The first practice test I got like a 73, and the second one that I did I got an 85.
Good. Good, good, good.
I
That's
see, that's where I'm getting confused. And I emailed him, and maybe the email wasn't clear. I don't know. For Louisiana, first of all, you don't have to have a pre-licensing course. But obviously, I decided to take it because I wasn't going, it doesn't make sense to go in there blindly. But there's only one practice exam. So and I asked him this in the email, is that exam condensed of all of those quizzes? Because I hear him talking about you can get these 5 or 6 practice exams.
Mhm.
okay.
So
Let
I'm
me
not really clear because for me, obviously they're quizzes after you finish the chapter. I understand that. But I don't see with my being the state of Louisiana, I just see one exam. I do not see those 5 or 6 exams because according to him, and this is his quote, they're pretty dang close. He said, dang, they're pretty dang close to the actual test. But I only see for the state of Louisiana one exam, period.
Okay. Let me talk to him about that and I will get back to you. What's your email?
Sure, you want me to tell you, put in the chat, whatever easier for you.
Either one. I have pen and paper or you can say
Okay, it's Karen, it's really my name, Karen, Karen, Anne, Singleton, Singleton, is in terrific, ON @gmail.
okay.
And the reason why I asked them that question is because I'm scheduled to take the test Monday
Okay.
and I need to know. I mean, where are these 5 or 6 exams? But he says per the email that they're in there, but I don't see it in mine.
Okay, so I'll ask him and then I'll get back to you. And let me just send him a text right now so we can get that
Yeah.
started, just because you are taking the exam on Monday.
Yeah. Since he's stating they're so close, I would like to practice on those.
Um, okay, so I just sent him a text and I'll let you know what he says.
Thank you very
Um,
much.
yeah, of course. Of course, of course. I know that he's, continuously building out the platform. So I don't know if it's a glitch or maybe he hasn't gotten to those. I'll talk to him. I don't know everything about every state because
Mhm.
there's a there's a good amount of them.
Right, understood. And it could just
Definitely.
be because Louisiana doesn't require the pre-licensing. I don't know. I don't know.
Okay, yeah, I'll talk to him and see what he says. And if he reaches back, he's pretty good about texting me back, so we'll see. Um, but for now, we have about oh, you. Hey,
Hello.
sorry.
No problem. I have a certificate of completion. So where my confusion was coming in at was with the certificate of completion, is there another exam that I needed to complete, or was this it,
I
other
think
than going to take the?
that should be it if you have the certificate of completion. Um, it I definitely would suggest to go back through them. Like I said, the exam questions are very good to use before taking the actual exam. So certificate of completion, that should be, you went through every single module and everything.
Mm-hmm.
Yeah, so you're good on the pre-licensing portion, but like the big exams at the end, I would take them a few times and then go in and take the exam, and you'll do fine.
So do you just find your location, your testing location for the final exam?
Mm-hmm. Yeah, so it'll be like a Pearson view, VUE, Pearson view. I don't know, never known how to say it. I've taken so many damn exams there, I'd never know how to say it. But Pearson view, maybe,
Mm-hmm.
testing center, and you can just go in and essentially sign up for that exam. Are you signing with a company already or not yet?
I thought it was with, I haven't signed up for one yet. On the Justin Insurance or Just Insurance website, it do show an exam to take for $19. That's by Pearson View. So is that
Yeah.
the one I need to be doing?
Let me double check on
How
that.
she would find out, she's going to have to Google her state outline exam and it would tell you if it's Pearson View or PSI.
That's a good point. Didn't even
The
think about
state
that
outline.
one.
Mm-hmm. If you
So,
Google state outline exam for life insurance, it's going to bring up the outline, meaning everything that is going to be on the test. And I'm not saying the questions, but every topic. And then it would tell you if it's a PSI exam or if it's a Pearson exam.
Okay. Because what I see on there is Pearson View, but I thought you had to go into a center.
Yeah,
you
you still
do.
have to go into the center, but what she was saying was to know what test it would be because
Okay.
the PCI test is going to have, it's not going to come from the same testing bank as the Pearson test bank.
Okay.
That's what
Okay.
she's saying.
Thank y'all for clearing that up.
Of course.
Of course.
I can also reach out to you if you have any other questions um, on that, just like scheduling exam and everything like that, because at least in Florida, we have to get fingerprinted and do all that. I don't know, Karen, is that same
It
thing?
is. Yeah.
Okay, yeah.
Mm-hmm.
So probably have to do the fingerprinting, do the background check. I'm assuming that's the same in every state. So I can help you through that whole process. Uh, let me get, if you want to text it or tell me, you want to text in the chat or tell me either one, I'll get your email too, and I'll just send you, you know, just, hey,
Okay.
whenever you need help.
Well, it's L Jessie, LJESSIE,
Okay.
McElveen, MCELVEEN at gmail.com. I'm sorry, 512 after McElveen at gmail.com.
512. Okay. And it's MCELVEEN.
Mm-hmm.
Okay.
That's correct.
Perfect. All right. So we have about 4 more minutes until our break. So let me go through, we can do a few more and then we'll take another 10-minute break. see. And home. Slideshow. From current slideshow. Okay. So adverse selection. What do you guys think?
This has something to do with mitigating the risk with a
Okay.
large group. I'm not very clear, but I have some of it.
Okay. So refers to the likelihood of individuals with higher risk profiles being more inclined to purchase or maintain insurance coverage, which can be detrimental to the insurance company. Effective underwriting practices help mitigate this issue. Okay, so adverse selection, okay, it's pretty much saying, hey, we don't want to take on a bunch of people with just high risk, who are just high risk, because that creates a lot of risk for the insurance company. And insurance company, they want to take on people, obviously, because they want to, make money and be a part of the game. But, you want to take away from the idea that people that are at higher risk may be the ones mainly searching for insurance. But if an insurance company only has a group of high risk individuals, that puts the insurance company at a lot of risk. I know I'm saying a lot of the same words over and over again. Is that making any sense at all?
It is.
Okay. So it's pretty much just making sure that they're taking on a range of individuals. Okay. So people who are low risk, medium risk, high risk. Okay. So they don't just have this plethora of high risk individuals that causes the insurance company to have a lot of their own risk.
Understood.
Okay. Is everyone else still with me or no? I can try to re-explain that.
Yeah, I'm good.
Good?
Yep.
Cool. Okay. So a 62-year-old smoker with a history of heart disease applies for life insurance. Knowing his health increases the chances of needing coverage. The insurer recognizes the risk, charges a higher premium after reviewing his medical records to offset the potential costs. Okay, so we talked about this more. They have a high risk individual, they pay higher premiums. Okay. Again, that's to kind of offset so the insurance company doesn't just take on a bunch of risk without having some backing to kind of help them out with that.
Understood.
Perfect. Age change. What is age change? This is a very general idea.
Well, suppose you mistake your age. And what happens is, oh, this is age change. I'm sorry. I was going down someplace else.
I know where you're going. That's okay.
Oh my gosh, let me just be quiet.
No,
Okay.
you're good.
Let me read the definition. Oh my goodness. Okay.
So age change. So Karen's talking about something that we're going to get to in a little bit, but age change in particular is a specific date midway between an individual's birthdays when their age is considered to move to the next higher age. Okay. So some insurance companies calculate this based on the nearest birthday while others use the last birthday. Okay. So Maria applied for a life insurance policy on June 10th and her birthday is on July 1st. The insurance company uses a rule called age nearest birthday, okay? Meaning they round your age up or down depending on how close it is to the next birthday, okay? Although Maria is still 29, when she applies on June 10th, when she gets the policy on June 10th, okay, her birthday is only 3 weeks away. So the company rounds her age up to 30, which affects her premium, making it slightly higher than if she had applied the earlier year. Okay.
Yes.
So
Yeah.
age change is exactly what it sounds like, just changing the age a little bit to either benefit or protect, whatever word you want to use, the insurance company or the insured. Okay. Applicant. Who is the applicant?
Person applying for insurance policy.
Good. The individual who fills out and submits an insurance application to the insurance company. Generally, the applicant is the person to be insured, though it's not always true. Sarah completes an application for a life insurance policy on behalf of her elderly father. Although she is the applicant, her father is the one being insured. Sarah provides all the necessary information and signs the documents to submit the application to the insurance company. If Sarah were to apply for her own life insurance, she would be the applicant and the insured. So the applicant doesn't have to be the insured.
Correct.
Good. Application. What is the application?
The item that's filled out and the request insurance coverage.
There we go. A document containing essential information provided by an individual when applying for health, life, or disability. This information is crucial for the insurance company's underwriter to decide if the applicant meets the company's criteria for coverage. The application becomes part of the insurance contract. Okay, so at the end, when you have everything settled and you have an insurance contract, the application is going to be part of that. When someone applies for a life insurance policy, they fill out an application detailing their personal and medical information, which the underwriter reviews. Attending physician statement.
This is a statement from a medical person. We're going to say doctor since we have a physician here, that they may need more information. For example, maybe I say I have an autoimmune disease. Well, that's very general. So they're going to need a statement clarifying that.
Good, 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 good. So a document requested when an application or medical examiner's report uncovers current or past conditions or circumstances requiring further clarification. So I said, hey, you told us you have a heart condition. We need more information. Okay, the applicant must authorize the release of their medical information due to patient confidentiality, HIPAA, right? Allowing the physician to share details with the insurance company's underwriter. During John's life insurance application, his medical exam reveals a history of high blood pressure. The insurer requests an attending physician statement from John's doctor to get more details about his treatment and current condition. John signs a release form allowing his physician to provide the necessary medical information to the insurance company's underwriter for further evaluation. Okay, so an attending physician statement. Don't get this confused with an attending physician, which is someone who went through medical school, residency, and now they're the attending physician. Okay, attending physician statement is very different because that's an insurance, and attending physician is a medical term. Okay, backdating. What is backdating?
How far we can backdate the policy.
How far can we backdate a policy?
And we can backdate it to 6 months.
That's right. So it refers to the practice of assigning an effective date to the policy that is earlier than the actual application date. This technique is used to reduce the applicant's age on paper, thereby securing a lower premium. State regulations typically restrict backdating to a maximum of 6 months. Backdating is prohibited for variable contracts due to the inherent investment risk. If a 30-year-old applies for life insurance but wants to benefit from lower premiums applicable to a 29-year-old, they might request to backdate the policy to when they were 29, as long as it's within 6 months of the application date. Binding receipt. Unconditional receipt. What is this?
Binding receipt is when I give you the receipt and insurance can start immediately as long as all the conditions have been met.
Okay, also known as an unconditional receipt. It's a type of acknowledgement given by an insurance company when an application is completed and the initial premium is paid. This receipt ensures that the insurance coverage becomes effective immediately on the date of the receipt and remains active for a specified period or until the insurer makes a decision on the application. Okay, so you can look at it two ways. It's one, the insured it gets a benefit because they can just start getting the benefits immediately, okay, even if the application isn't completely approved, okay, so they can get these benefits immediately, but a binding receipt can also be on the side of the insurance company where it says, hey, we got you, you can't leave now. Okay, when a person when a person submits an application for insurance and pays the first premium, they receive a binding receipt ensuring their coverage starts right away and continues unless the insurer denies their application. What is a buyer's guide?
You're up, Will.
It's a guide provided to the insured to be able to look over all the clarifications of the policy, all the things that are included in it, beneficiary amounts, death amounts, all the stipulations in the contract before their final approval. It's what they're given in the free look period.
Perfect. So a brochure that outlines and compares different types of life or health insurance. Producers are required, we are producers, required to provide this guide to potential customers when soliciting insurance, enabling consumers to make well-informed decisions about their insurance purchases. Okay, so you have to give them all the options, and you can advise, you can inform, but they're the ones that have to make the decision. Okay, so a buyer's guide allows them to look at all their options and make a decision based on what they believe. People also like having the power. When someone's told what to do, they don't really like it, rather than giving the option and they feel as though they're making the decision. That's another thing in sales, is that you want to make the person feel like they're the one making the decision, not you pushing it on them.
Great sales technique. That's wonderful.
Okay, so when an insurance agent meets with a potential client to discuss life insurance options, they provide a buyer's guide that explains the various policies, helping the client understand their choices before making a decision. What is it?
I have a question because we don't want to take all the answers. Is the other lady here?
Let's see.
I'm here.
Yeah.
Okay, we just don't want to leave you out.
Nope, you're not. And some of this I have, some of it don't, so that's why I'm quiet.
No, you're totally good. However, again, this is about you guys. If you are just kind of a sit and listener and that's how you learn, that's how it is. You know, it's definitely not one size fits all when we sit here and we go through. I learned that when I was teaching chemistry. I would sit up there and I'd do this whole thing, and you know, someone just wouldn't get it no matter what I did, and I'd have to completely change my style just because people are different types of learners, and that's totally fine.
Absolutely.
Yeah, I love to participate. When y'all hit on something I know, trust me, I will be speaking up.
There you go. I love it. Okay, what about conditional receipt?
That is a receipt given. For example, I give you a conditional receipt as long as you pay the premiums and all the conditions are met. Then you'll be good to go to have insurance.
Perfect. Perfect. A document given to an applicant after they complete the application, and often after a required medical exam. It provides temporary insurance coverage, but only if certain conditions are met. Typically, the applicant is found to be insurable under the company's underwriting guidelines. So that temporary insurance coverage usually isn't full coverage. It's usually just a little bit during that time of like the processing time. So they do have a little bit of coverage, but it's not full coverage. I'm not going to read everything on this. Okay. So here's an example. Sarah applies for life insurance and pays the first premium. The agent provides her with a conditional receipt, which states that if Sarah passes her medical exam and meets the insurer's underwriting requirements, coverage will be retroactive to the date of the receipt. Okay? However, if Sarah does not meet the requirements, the policy will not be issued and the premium will be refunded. Okay, here is a very good thing to think about as well. So John applies for life insurance on May 1st, pays the first premium. He receives a conditional receipt. An insurer later determines that John's health issues would have caused him to reject the application. If John dies on May 5th, the insurer would not pay because he did not meet the conditions. Okay, consumer report, investigative consumer report. It's the same thing, just another name.
That's when I'm being investigated. Well, you have it up. Yeah, for example, they may talk to my neighbors, coworkers, just understanding my lifestyle.
Mm-hmm. So that's like the really in-depth underwriting, right?
Mm-hmm.
So it's literally an investigation. So it's when an in-depth background check that may involve interviews with applicants' colleagues, friends, and neighbors to assess their character, reputation, and lifestyle. So think about what they would say about you. Maybe that's an incentive to make good connections and keep good connections. So insurance companies can perform these reports to gather more information about an applicant, provided it does not infringe on privacy. A credit report is a common example.
Mm-hmm.
So David applies for a high value life insurance policy. Now keep in mind, this kind of in-depth underwriting usually is because you're applying for something very, very expensive. Okay. He applies for a high value life insurance policy, and the insurer requests a consumer report to assess his financial stability and lifestyle. This includes reviewing his credit report and public records to evaluate his risk profile. The information helps the insurer determine the appropriate premium and whether to approve the policy. What is a credit report? We know these.
Yes, when they're investigating our credit, but before they do that, they do have to obtain my written consent. And not only that, if I want to know what bureaus, they have to provide that to me as well.
Good. Perfect. So a credit report provides a summary of an insurance applicant's financial credit history, including their credit score, debt levels, repayment history, and perceived credit worthiness. This report is prepared by an independent organization that reviews the applicant's financial standing. Credit reports are usually sourced from one of the three primary credit bureaus. Sorry. When Sarah applies for life insurance, the insurer requests her credit report from hold on, something came up. Okay, when Sarah applies for life insurance, the insurer requests her credit report from Experian. This report provides a summary of her credit score, debt levels, and repayment history, helping the insurer evaluate her financial responsibility and assess the risk involved in offering her a policy. Okay, declined risk. What is a declined risk?
I'm gonna let somebody else talk. I have to step away for a moment.
Okay. Oh, sorry, y'all. I totally went over. See, this is what happens when I don't set my alarm. Okay. Do you guys want to take a little break here?
Yeah, that's fine.
Okay. I'll see you guys in 10 minutes. So 2:15.
Okay.
Okay.
All right. I'm gonna set an alarm this time.
Sure.
Let's see. Stop. Okay. 50 minutes. Okay, let's get back into it. Let's see, we're here. Okay. Wait, slide. Okay, so declined risk. What do you think?
Your application was declined. Too high of a risk.
Okay, refers to a person whose insurance application has been denied by the insurer. You're exactly right. An example, if an applicant has a severe health issue that falls outside of the insurer's acceptable risk parameters, their application may be categorized as declined risk and subsequently denied. It's unfortunate. Disclosure form. What is a disclosure form?
I'm gonna let somebody else talk.
Yeah, that is when you disclose all your current health conditions, full disclosure of all your personal information, that is warranted on the application itself.
Good. A standardized document mandated by various state regulatory bodies to be provided to every policyholder when an existing insurance policy is being replaced with a new one. Okay? So everything, like you were saying, has to be disclosed. Okay? If you're replacing anything, changing anything, it has to have a disclosure form. For the disclosure form in particular, it's usually when one is being replaced with another. Okay. So when John decides to replace his current life insurance policy with a new one that offers better benefits, his insurance agent provides him with a disclosure form as required by state regulations, explaining the differences between the two policies and any potential drawbacks of replacement. This ensures John is fully informed before making the switch. Okay, so anything changing, I guess not anything, but if you're changing the base policy, then that's something that you'll have to have a disclosure form for, just so you don't do it without them knowing or anything like that. Evidence of insurability.
You have to prove.
That's
Go ahead, Will.
right. You have to, like Karen was saying, you have to prove that you can pass a medical exam, that you are in good health, and that all the information you put on your application is truthful by passing your medical exam.
Okay, good. So refers to the information an insurance company uses to determine whether an applicant is an acceptable risk. It typically involves details about person's lifestyle, occupation, or medical history, and may include a health questionnaire, medical exam, or lab tests. It verifies their qualification for insurance coverage. Okay, evidence of insurability. Do you have evidence that you are insurable? When Emily applies for a life insurance policy, the insurer asks for evidence of insurability. She provides her medical records and completes a medical exam to verify her current health status. This information helps the insurer determine whether she qualifies for the coverage and what her premium rates will be. Fair Credit Reporting Act.
That is an act that protects consumers. And again, we have to let them know that they are being investigated. But before we do that, we must attain their written consent.
Okay. Okay. So it started in 1970. It's a federal law that allows insurers to obtain additional information about individuals applying for insurance coverage. This legislation authorizes insurers to conduct consumer reports on applicants and prospective insured. The insurance applicant must be notified of the purpose of the report. If coverage is denied based on the report, the insurer must provide the name and address of the reporting agency so the applicant can request a copy of the report. Okay, so hey, can we do this report? Hey, you were denied. Here's the information about who you were denied from and why. Good?
Yes.
So
Yep.
Michael asks for life insurance, and the insurer informs him that they will obtain a consumer report as allowed under the Fair Credit Reporting Act. The report will provide details about his credit history and financial responsibility. If Michael is denied coverage based on the findings in the report, the insurer is required to give him the name and contact information of the reporting agencies so he can request a copy and review the findings, which is fair. You know, if you're denied for something, I'd probably want to know why, right?
Exactly.
There we go. A field underwriter. So we have an underwriter and then we have a field underwriter.
Field underwriter is us.
Us.
We working in the field, gathering information.
Perfect. Perfect. So refers to the agent or producer responsible for completing the insurance application on behalf of the applicant. So Karen, you're exactly right. It is us. When someone applies for life insurance, the field underwriter gathers all necessary information, fills out the application, and submits it to the insurance company for review. Okay, so we're out in the field, we're doing all the dirty work, kind of. Okay, so we're out in the field, we're getting the initial information, everything like that. I think, okay, I don't have it yet, but you'll see the difference between an underwriter and a field underwriter. An underwriter usually is in an office or something like that, right? They're doing the more deep dive. Okay, the field underwriters are kind of just the normal age, date of birth, things like that. Okay, free look period. What is the free look period?
It gives,
Go ahead, May. Go ahead.
okay, I'm coming. It gives the applicant 10 days. Well, I know in my state, I don't know if it's in every state, but it's 10 days to look
Yeah.
at the policy, and it gives them the opportunity if they want to return it as well.
Perfect. Okay, I'm so glad you said that because it is not the same in every state. Okay, fortunately, you just have to know it for your state unless you decide to sell in another state, then you can figure it out what it is for that state. I personally don't know what it is for every state, but make sure you know it for your own state. So a mandated time frame, typically at least 10 days, like you were saying, during which a policyholder can review a life insurance policy after delivery and return it for a full refund if they are not satisfied. This time frame starts when the producer hands over the insurance policy. For a mail order or direct response policies, the free look period is extended to at least 30 days. Okay, so it's a trial period. It's like, hey, do you like it? Do you not? Okay. After receiving their new life insurance policy, the policyholder has 10 days to review the terms, and if they choose to return the policy within this period, they will receive a full refund of their premiums. What is the inspection report?
This one I don't know.
That is when it's regarding the credit report.
Okay.
No, let me read it. I don't think that's correct. Provides
Okay.
about insurance applications. Oh, okay. So I guess that's another deep dive as well.
Yeah. So a document that provides general information about an insurance applicant's reputation, health, lifestyle, and financial status compiled by a firm specializing in these investigations. So it's a little bit of everything. And there's a firm that you can kind of go to as a one-stop shop and say, hey, can you do a deep dive on this person? Gather everything that you can. So that's an inspection report. A credit report is very specific, obviously, to just their credit. Okay, when applying for a high-value life insurance policy, Lisa's insurer requests an inspection report to gather more details about her lifestyle and financial stability. A third-party investigation firm interviews some of Lisa's acquaintances and reviews her public records to compile a report on her reputation, health, and overall financial status. This report helps the insurer assess her insurability and set appropriate terms for the policy. Okay, there we go. Consumer report versus inspection report. Okay, So let's compare these because they can seem a little bit similar. Okay, so inspection report is personal interviews and references. Consumer report is mainly a credit reporting, mainly you base it off of credit reporting agencies. Okay. So, and again, inspection report, you're getting lifestyle, reputation, habits. You can't even get credit. Consumer report, just think about money, everything they consume. Okay. I guess in a way. Okay. Credit report, debt, financial info, all about the money. Okay. Consumer, money. A consumer spends money, right? Inspection, they're inspecting everything. Good?
All right. Yes.
Oh,
Thank you.
of course. Medical Information Bureau.
This is when insurance, or was somebody else getting ready to speak? No, I thought I heard something. Okay. This is when the Medical Information Bureau will share information just to make sure, like, for example, I said that I never had cancer to one insurance company, then I went to another insurance company. I said I did have cancer. So it's a way of them sharing that medical information.
That's perfect. That's perfect. What was that?
Oh, nothing.
Nothing. Okay. Yeah, so you'll see this called MIB a lot. So just kind of know that term, MIB. But you're exactly right, Karen, an organization that compiles medical data on applicants for life and health insurance on behalf of its member insurance companies. All right. During John's life insurance application process, the insured checks his records with the MIB. The MIB provides data from previous insurance applications, revealing John's history of high blood pressure. This information helps the insurer verify the details John provided and assess the risk in offering him coverage. So Karen, you gave a perfect example because that was the example that we had on here. Okay, policy summary. What is the policy summary?
That's the summary of all the different aspects of the policy given to the applicant, outlining all the terms.
Perfect. It's the summary, right? So a concise document outlining the key terms of the insurance policy, including coverage, including coverage restrictions, conditions, and premiums. These summaries are commonly provided for long-term care insurance, life insurance, and annuities to help consumers understand their policy's basic details. So a lot of people that you write policies for are not going to read all the little things in between. They want to see a one-page summary. I want to see what I get, what I don't get, and that's it. So when Maria receives her life insurance policy, it comes with a policy summary that outlines the key details. The summary includes her coverage amount, premium payments, and any exclusions or limitations, such as conditions that may not be covered. Policy summary helps Maria quickly understand the main points of her policy without reading the full contract. What is preferred risk?
And it means that you are very healthy and you're good to go, and we can assure you and your premiums will be low.
Perfect. That's perfect. We've talked a lot about this today without actually giving it a term, but that's exactly right. So preferred risk is an applicant who is considered to have lower than average risk. Okay, so they're very healthy, they work out, they eat good, all these other things. So they have a lower than average risk of filing a claim due to their superior physical condition, lifestyle, occupation, and other favorable characteristics compared to others in the same age group. Okay, this is where we'd all like to be, right? We get lower premiums, and obviously, looking at this definition, we're like shredded and everything else. So this is where I want to be. I don't know about y'all.
Yes, I do too. And
Right?
not only for insurance, just for your own, you live better when you're healthier. It's just a better life.
Of course. Of course. All right, so a non-smoker who exercises regularly, has no chronic illnesses, might be classified as a preferred risk, resulting in lower insurance premiums. Perfect. Proposed insured is a proposed insured. So
It's the person who's being considered for a insurance policy.
good. Okay.
Yes,
So
excellent.
that's perfect. Yeah, it's the who you're proposing who's going to be insured. okay? The individual whose life is being considered for insurance coverage. While often the same as the applicant, it's not always the case, and we saw that earlier, right? I don't know if it was Sarah or Lisa. I feel like we've heard a lot of those examples, but one of the two applied for her father, right? So she was the applicant, but he was the insured. So he would be the proposed insured. Okay, in a situation where a parent applies for a life insurance policy on their child, the child is the proposed insured, while the parent is the applicant. What is a rated policy?
I don't know.
Okay, let's talk about it. So it involves an additional charge added to the standard premium due to the insured person being considered a higher than average risk. Okay, this higher risk assessment can be due to factors such as poor health or hazardous occupation. You jump out of airplanes for a living. Okay, so a rated policy, like it says, rating up. A rated policy is when someone is super, super crazy and does really, really crazy stuff, or they have very poor health. Okay?
Yes.
Good?
Yes.
I can give you guys an example. My brother works with snakes for a living. He's a herpetologist. He is applying to medical school right now, so he's kind of going on a career change path. But he works for snakes, and he worked in a lab, and they took the venom out of the snakes and did research on it. So he has a very hazardous occupation. So he'd probably have a rated policy. And then, outside of his driving skills or adding on to his driving, his policy would be very, very rated. Very rated. Think about like rated R. Very bad. Okay. If an applicant has a history of heart disease, they might receive a rated policy, meaning they will pay higher premiums to account for the increased risk. Replacement.
That's when, well, first we want to make sure we're doing this in the best interest of our client, replacing one policy for another and explaining all of the details regarding that. That ties in with the disclosure form.
Good. I was about to ask that. I was like, we just talked about, okay, good. Disclosure form. You need disclosure form if you're going to replace anything. Okay. So involves a producer legally encouraging a prospective client to cancel or surrender an existing life or health insurance policy in order to buy a new one. Okay. This activity requires the producer to provide a notice regarding replacement to the consumer and inform the insurer about the replacement. Okay. And that kind of is all tied into what you were talking about, the disclosure form. You have to disclose all of this. So when an agent recommends that a client switch their current life insurance policy to a new one with better terms, they must provide a notice of replacement and notify the new insurer of the change. All right. Risk classification. We already did a few of these.
Yeah, that's the classifications regarding the risk, meaning if you're going to have the preferred, substandard, or standard. It's how you are classified regarding your premiums.
Good. I love that you know all those. Okay, so refers to the underwriting category assigned to an applicant based on their likelihood of experiencing injury, illness, or death. Okay, so we just talked about one of them. We'll talk about the other two that Miss Karen talked about, substandard and standard. Okay, so after reviewing Mary's life insurance application, the end medical exam, the insurer replaces her in the preferred risk classification, which we just talked about. Due to her excellent health and non-smoking status, this classification qualifies her for lower premiums because she is considered less likely to experience illness or death compared to higher risk applicants. Okay, special class. What is special class?
Someone else can talk.
That one I don't know. I'm not sure of that one.
Okay, so let's talk about it. Refers to an applicant who doesn't qualify for a standard policy, but may obtain coverage with an added rider that excludes payments for losses related to certain pre-existing health conditions. These applicants may have to pay higher premiums or accept a different type of policy than the originally than the one originally applied for. Okay. So, hey, you have a heart condition. If you die because of that heart condition, we will not give you a death benefit. But if you die for any other reason, we will give you that death benefit. Okay, so it kind of has like an exclusion on it. Make sense?
Mhm. Yes. And
Yeah.
really that could be tied in, I don't know, tell me if I'm right or wrong, to the surplus lines in a
Okay,
way, because nobody wants, I shouldn't say nobody wants to insure. They just have a higher risk.
good. Okay, so explain a little bit more. So what is it? Tell me what a surplus line is again.
That is when, for example, it's fine for me to find coverage because I'm just not well and no one, I'm a high risk. I'm just a high risk. So there's a surplus line that will insure me with their products. I may have, my premium's going to be higher since I am such a higher risk.
Perfect. That's exactly right. I'm so glad you made that connection. You're exactly right. So they can do a surplus line. That's perfect. All right. So John applies for life insurance, but is classified as a special class applicant due to his diabetes. Although he cannot qualify for a standard policy, the insurer offers him coverage with a rider that excludes any claims related to his diabetes and requires him to pay a high premium to account for the increased risk. This allows John to still obtain coverage. Not sure what that word was supposed to be, but it's a coverage with certain limits. Okay. Standard risk. What is standard risk?
I just spoke, someone else can talk.
The standard risk, I'm guessing, is the standard risk that the insurer is willing to take on in order to guarantee or effectively sign a policy into effect.
Good. Okay. So standard risk is an average person, right? So it describes an individual who meets the average risk criteria according to an insurance company's underwriting standards, making them insurable at regular premium rates. Okay. Candidates classified as high risk or low risk may be eligible for higher or lower rates depending on how much they differ from the standard risk category. So standard risk is the average across all boards. Just, and then so it's the standard risk across all boards, and then they base their premiums on that. Okay,
So
so
sorry I wasn't talking as much as I was before. Right before we started, I accidentally clicked to start one of my practice quizzes, and I didn't want to get big fat 0 on it. So in the interim of trying to
to
give
complete.
answers and
Yeah,
reply,
yeah,
I
yeah,
was
right,
trying to take
Will.
the quiz.
That's
I
such a
was
great
panicking because even
excuse.
if you close it, it still counts down the timer. So I went
Oh,
from like
you're
an hour and
good.
58 minutes to an hour and 27, and I was like, oh no.
Oh, geez. Okay, yeah, no,
So
no worries at
I'm
all.
good now. I'm good. Quiz
Oh,
is
you got
done.
it.
I got an 83. I'm good.
Good.
Yay,
Yay.
Will.
Did anything we talk about today help at all?
A lot of it, actually, a lot of
Good.
the questions that popped up in there were stuff that we covered today. So about
Perfect.
the payer rider, different types of riders, different types of insurance. The ones that I get hung up on are like the universal life and the variable life. So it's been helping having this talk and then even redoing that or doing that quiz. I ended up
Good.
getting some of the questions I got wrong before right. So.
Good.
Good.
Yay. Okay,
Excellent.
I'm happy. Very, very happy. Okay.
Congratulations, Will.
Yeah. Heck
Thank
yeah.
you, Miss Karen.
Another one down. Okay. So we talked about standard risk. Do you guys want me to continue? When you guys know something, do you want me to read the definition or the example of it? Or do you want me to kind of just skip over it so we can go to the next thing?
Personally like to skip over it, but it's up to the
Okay.
group.
Yeah, I'd say only if somebody says they're not fully understanding it, then we
Exactly.
could kind of touch on it more. But
Go into the example.
if we're
Perfect.
all in agreement, I think we can jump over it.
Heck yeah. Okay, I'm definitely down with that. Okay, substandard risk.
I know what that is.
Go ahead.
That means, unfortunately, you're just a risk. But
Yeah,
it doesn't mean that you're not insurable.
True.
because they may need additional information and that you probably can be insurable. So
Very true.
all is not lost.
That's exactly right. Okay. So substandard risk, you're just lower than average. You have a higher risk, whether that's because you have diabetes, whether that's because you have a hazardous occupation. Your risk is lower. I mean, your risk is higher. Okay. We good on this one?
Yes.
Yep.
Perfect. Right? Underwriter. Did we have this one? We had this
Yeah,
one.
we did. Mm-hmm.
I gotta write this down so I delete it from the PowerPoint. Okay. So we had does anyone want to talk about underwriting again?
I'm good.
Oh, here we go. Field underwriter versus underwriter. We already talked about this, but field
Hmm.
underwriter is in the field, right? It's the agent, it's us, okay? And then the underwriter is usually someone who's at the insurance company, okay? And the underwriter in the office is usually the final decision maker. Field underwriter, we just give all the first, the first information, the plain insight information. Good on this one?
Yes.
Yeah.
Good.
Excuse me.
We know what underwriting is?
Yes.
Yes.
Kahoot. All right. Do this. So stop sharing. What do you guys think about the Kahoots? Do you guys like going through them in questions or no?
I think they're good.
I do too.
Okay, good.
Like Karen said, it gives a different way of just covering the information. It makes it a little more fun. It's not
Absolutely.
just dry and bland where you're falling asleep staring at your phone or your computer.
Yeah.
Like I was at most of the course. So
Good.
had to revisit quite a few things because I wasn't sure if I read it, but I wasn't sure if I understood it.
Yeah.
So
I've been there. Gosh.
Absolutely. We all have. And
oh
and
yeah.
I'm
Yeah.
still there. Yes.
You read a whole page and you're like, what the heck? Did I just
Well, yeah,
read?
I'm already at the bottom of the paragraph and I'm like, I don't remember those first six sentences coming out of my
Exactly.
mouth. So I have to read it out loud to make
Right.
sure that I've read everything because just reading with my eyes, I'm like, yeah, I don't think I understand that at all.
Yeah, exactly. Exactly. Have you guys ever sat and reread the same sentence like 8 times and you still can't understand it?
Oh, you
Absolutely.
only did 8? I've done more than 8, yes.
Absolutely.
Eh,
Right.
Yeah.
And please let Justin know this class is so, so helpful. Oh my gosh, he
Oh
should
yeah.
push it
Yeah.
more.
Okay, tell him. Send it. I'll let him know too, but send him an email
I
or
will. I will. But tell him, don't forget my question. I need that ASAP. I'm taking the test Monday.
so.
And if
Let's
I don't pass that test, I will fly to Puerto Rico where he is.
see. Okay, so let's see. He says we have 5 practice exams in each $37 packet. She has to go into the Louisiana Life Exam Prep and pay to extend it. Inside her course, it's a $39 extension.
Oh, okay. So it wasn't what he told me in the email because he said it was already in there. Okay.
Okay, so let me just make sure. Included what she. Alright.
And I have the email to back that up and I can forward that to him.
Okay, so I just asked just to make sure it's not included what she has already, she has to add on to it. If that's true, then send him that email again and be like, hey, this is what you said.
Absolutely, I will.
Okay. Perfect. So let's go ahead and do our little Kahoot. Okay, can you guys see my screen?
Yes, ma'am.
Yeah.
Perfect. Start. Or don't. That's fine. I guess you don't have to. Start. Oh, it's the typo. Look, I'm having so many issues with Kahoot today.
That's
I need to
okay. It
take a class.
happens.
Let's see. Present. Let's try this one. Okay. He said she has it and she's already gone through it, but she already got past her 30 days. It expired April 28th.
No. I renewed it. I'll speak with him off camera because I renewed it. It's extended to May 26th.
Okay. To May 26th.
Mm-hmm.
Okay. I sent that to him, but yeah, if you want to continue this conversation off camera,
Yeah.
feel free.
I'll keep you out of it, doctor.
Thanks. Okay. Ready to I am ready to start. Are you gonna give me a start button or what's going on? Come on, Kahoot, work with me. No, this is the same thing that we're doing before. Gosh dang it.
Do you think it's waiting for us? Because it keeps saying waiting for participants, but there's a way that you did it without us going in there.
Yeah, I know. That's what I
Maybe if you go to learn, I don't know.
learned. Okay, this works. Can you guys see this?
Yes.
Yeah.
Okay, perfect. So, what is the term for the tendency of high-risk individuals seeking insurance more than low-risk individuals seeking insurance?
Substandard
And
risk.
So let's read it again. So what is the term for the tendency of high-risk individuals
Oh,
insurance more than the low-risk? So it's saying
adverse selection.
selection. Yeah. I
adverse
misread too
selection.
fast.
Wait. Oh, I clicked it. Okay, I clicked. Oh my gosh. Oh my gosh. What is going on? Okay. Adverse selection. We got it. I don't know what just happened there. Okay, adverse selection. Okay. Which document becomes part of the insurance contract and contains personal and medical information of the applicant?
Attending physician statement.
Okay. What do you think? Should we click that one?
Mm-hmm.
Yeah, I think so.
What?
Application.
That's
So-
misleading. Where is go back to that question?
Okay, so let's talk about it. So it contains personal and medical information.
Okay.
Mhm. I hear what you're saying. It is a little bit difficult. These are a little bit tricky. I have to say, it's like these are like medical exams. This is what they used to do to us. It's like the one word that's a little bit off. Okay.
Yeah.
So personal and medical information. So that's the application.
Understood. We're not going to be defeated, you all. We're going to really get this.
We're gonna get it. All right. A binding receipt is also known as a conditional receipt.
I'm going to say true.
Are we going with true?
Yes.
All right. Yeah.
Woo-hoo!
What is the purpose of backdating a policy?
To lower the applicant's age for a reduced premium.
Are we good with that one?
I mean, from the choices, yeah.
Yeah. So that is the main purpose of backdating. So I'll backdate, let's say 6 months to get coverage as if I'm 29 instead of 30. Okay?
Okay.
All right. The underwriter is responsible for completing the insurance application.
False.
True or false?
That's false.
That was quick. Are we good with that one?
Yeah.
Yay. Okay. Wait. Let's go back to it. Can you explain?
Yes. That is not our responsibility, and we cannot do that legally. We have to take it back to the applicant, and they have to initial and date it.
Perfect. What kind of document is used to obtain further medical details from a physician during the underwriting process?
An intending physician statement. And I know, Kahoot, you have that right.
We got it. Yay. Okay. What is provided to help consumers compare compare and understand insurance policies before purchasing?
The buyer's guide.
The buyer's guide.
Correct.
Woohoo! We're learning. I love
Yes.
it. Okay, a disclosure form includes policy replacements.
True.
Okay. If someone applies for insurance on another person, who is the proposed insured?
The persons whose life is being insured.
Sure. Yeah.
The person whose life is being insured. Okay. Wait, let's go back. Okay. Someone want to explain? I know it's very straightforward, but I feel like there was a little bit of hesitation there.
Well,
I hesitated.
she can go ahead because I explained. I know, but she could go ahead. I'm gonna give somebody
No,
else
I
opportunity.
didn't. That's why I hesitated.
Oh,
That's what I'm
well,
saying.
for example, you can only insure my life. Number one, you have to have my permission. And just because you're the applicant, you would be taking out insurance on me.
Mm-hmm.
But you still would need my permission to do so. You just can't just up and do it.
Right.
Okay.
Right. You need to have insurable
Sure.
insurance. So if someone applies for insurance on another person, who is the proposed insured? The person whose life is being insured, right?
Right.
All good there?
Yes.
Yes.
Perfect. Risk classification for someone who does not meet the standard criteria, but can still be insured with limitations. Sorry, started a little bit there.
Special class.
Special class. Yeah.
Special class. Are we all good with that one?
Yes.
Mhm.
Yeah.
Woohoo! Special class. All right. 8 out of 10. No, that's not right. We did better than that.
Absolutely.
Because I think the first one I clicked wrong. So that's not on y'all. Okay. Let me go ahead and share back here. All right. Play from current. Look, I'm getting really good at maneuvering across this computer, I have to say. I feel like that took me like 5 minutes last time. Okay. So, industrial life insurance. Did we do this?
We did.
Yeah, at the
Also
very
known as
beginning.
home insurance.
Okay. Good. Okay, I'm writing it down to take it out.
Oh, I found out too why it's called industrial life insurance because
Okay.
when it's industrial life insurance is a blanket term, and that's why workman's comp falls underneath it because they both do the same thing, where it's
Okay.
insurance that's provided by a company to insure their workers if they're injured during doing their job. So
Okay.
that most of the people that signed up for the insurance when it was first brought to fruition were factory workers. So that's where the industrial part comes from it.
Wow. So you're saying this was kind of the beginning of insurance. They would come
Well,
to
actually, I looked that up too, and the beginning of insurance can be traced all the way back to 1750 BC.
Oh,
Mhm.
wow.
Yeah,
Wow, look
with
at
King
that.
Hammurabi's code, it says King Hammurabi's code and early insurance. Um, The concept of insurance dates back to around 1750 BC with the Code of Hammurabi, which Babylonians carved into stone, a stone monument, and several clay tablets. The code describes a form of bottomry, I guess like bartership, whereby a ship's cargo could be pledged in exchange for a loan. Repayment of the loan was contingent on a successful voyage, and the debtor did not have to repay the loan if the ship was lost at sea.
Wow.
Wow.
That is
That is
So it
very
goes,
interesting.
insurance goes way back before the Geico Gecko and everything else. So I didn't know
impossible.
that until
I
we
don't
took one
believe
of our
it.
breaks, and I was like, "Where did insurance start?" And that's what came
Yeah,
up.
I love it. That is super cool. I love it.
Yay, Will.
Yeah.
Yeah, woohoo. I love it. I love knowing the history about things. So that's awesome. Heck yeah. All right. So we know industrial life, ordinary life insurance.
That's a whole life policy that covers your entire life and it endows when you reach 100 years old. And what that means, they'll say, hey, here's your money.
Okay. Okay, I see what you're saying. So offered by commercial insurers and is not based on weekly premiums. It includes various forms of individual life insurance, such as term life and whole life policies. So let's look at an example, because I know that can be a little bit confusing because you're like, isn't that like everything? But let's talk about it. So a 35-year-old individual purchases an ordinary life insurance policy from a commercial insurance company. There goes Biggie again, right back into the pool. I don't know where am I? Okay, so fine. So an individual will purchase an ordinary life insurance policy from a commercial insurance company. They choose a whole life insurance option, which provides permanent coverage with fixed premiums and a savings component. Unlike industrial life insurance, they pay premiums monthly rather than weekly. The policy remains in effect for their entire life as long as the premiums are paid. So the biggest difference here is they pay monthly rather than weekly. Okay. Does anyone have any questions? They need clarification? You're still a little bit confused, understand?
No, I understand it better now.
I do
Okay.
too.
Okay. Is everyone on the same page, or if you're not, that's totally fine. Let's talk about it.
I don't need to talk about that.
Just to move on. We're
I
done.
didn't mean it like that. I didn't.
So
Keep
I don't
moving.
want to talk about it anymore. Okay. So again, it provides coverage for the whole life of that person. Okay. Let's go on to the next thing. Group life insurance. We've talked so much about group life insurance. I really like group life insurance, and I
Yeah,
think
it is good.
or certificate holders do as well. So someone
Yes.
talk to me about it.
And not only that, the employer, they hold the master copy. And typically, not any insurability needs to be proven because the whole entire group is insured.
Right. Right. Anyone want to, I mean, there's a lot to group life insurance. Anyone
It is.
want to it?
Mm,
Group life insurance is like when a bunch of like a employer insuring employees. No.
Okay. I see where you're going. So they don't insure the employees, but they'll buy coverage for the employees. Okay. And they
Yes,
can
that's right.
they can either pay for all of it, they can pay for part of it, or they can pay for none of it, but just get the group benefits. Okay. So all of you guys were 100% right. Group life insurance is great. If you can get group life insurance, do that over doing it by yourself because you're going to get better rates, you're going to get better benefits. There's a whole array, a plethora of things, plethora of benefits that come from group life insurance. The only thing is that you're not a policy holder, okay? And you're a certificate holder. So let's say you've been working somewhere for 10 years, you have life insurance through them, so you have a certificate, and then you leave and you go work for someone else. Now it's on you to either convert that into an individual. Some people, sometimes you're allowed to kind of keep the group rates, sometimes you're not. You have to, learn about all that depending on who they're insured by and, everything in between. So covers members of a defined group, such as employees of a company, members of an association, or union workers. The coverage is provided under a not a singer, a single master contract with underwriting based on the group as a whole rather than individual members. A key benefit of group life insurance is that it typically does not require proof of insurability. So you're exactly right. A lot of times the underwriting process isn't as lengthy. Okay, are we good on this one?
Yes.
yeah.
Perfect. Term life insurance. What is term life insurance?
Yeah, that's
Uh,
okay, you go ahead, Will.
Oh, it's an insurance policy that is set up for a certain amount of time, certain
Perfect.
time period.
Perfect. It's a life insurance policy that is for a specific term. It's for a specific amount of time. Okay. It costs less than whole life insurance. So there's the benefit of that. Term life insurance can also be beneficial if you're paying off a mortgage or something like that, where, hey,
Decreasing.
if I go ahead.
Oh,
Decreasing.
it's decreasing.
Decreasing?
Yeah.
Perfect. That's exactly where I
Term.
wanted you guys to go with that.
Yeah.
Decreasing term life insurance. Okay. So as you go through and you continue to pay off parts of your mortgage, you'll have decreasing life insurance. So the death benefit will go down. Okay. And the idea of that is that if you die, you don't want your spouse or whoever else to have to be burdened with the cost of your mortgage or something like that. Okay. So you have this coverage, this extra coverage, this extra backing behind you during that time that you're paying something off or anything like that. Okay.
Yeah, because shit ain't getting cheaper.
Good. Exactly. Because it's not getting cheaper. You're
It ain't
Correct.
getting cheaper.
You're exactly right. Okay, so again, here it says the most affordable type of pure life insurance. Okay, are we good
Yes.
on this one?
Yes.
Yeah.
Okay. What about level term insurance?
That's where the premiums stay level throughout the entire term that the insurance policy is in effect. So the premiums can't go up and they can't go down.
Good. Okay, known as level premium term. Okay, so exactly what you said, the premiums stay level. Okay, so the premium costs stay exactly the same. Are we good on this?
Yes.
Yeah.
Cool. Decreasing to, if you guys are like, hey, I understand it, but I still want to hear an example, just stop me and I'll go back to the example, okay?
Sure.
Okay.
Okay, decreasing term insurance. We just talked about it.
Yes.
Are we
That
good on
is,
this one?
yes.
Okay, you can go ahead and explain it.
Oh, that is when we just talked about, for example, I have a home and I don't want my family when I am make that transition to have to take care of the rest of the mortgage. So I have this decreasing term insurance to give me coverage for that. So they won't be bothered with that.
Perfect. Perfect. Okay. So the face amount decreases over time while the premiums, you're still paying the same amount of premiums. Okay. So let's say my premiums cost $100. I'm still paying $100 for the whole thing, but the face amount, the death benefit decreases over time because, hey, I'm not going to need it in 10 years because I've been paying the mortgage for 10 years. So it's not going to be as big as it would be at the beginning of the 10 years. Does that make sense?
Yeah, because it's designed to do that.
Cool. I love it. All right. Credit life insurance. What the heck is credit life insurance?
Isn't that insurance where that it will pay off uh I forgot now. I just had that on that quiz and I got it right on the quiz and now I can't pull it out of my brain.
That's okay. That's okay. So it
Frustrating.
uses decreasing term life. Do you want to try it? You want to? Okay, so it uses a decreasing term life insurance policy where the policy term matches the loan period and the face value decreases along with the loan balance. So this is what we were talking about. This is the exact example that we were talking about with decreasing term life insurance policy. Okay, so the purpose is to cover the life of the debt, ensuring that the loan is paid off if the person who holds the debt passes away before fully repaying it. Okay, so we have decreasing term life insurance. That's what we're using. But the term, when we're using it to pay off something, when we have debt and we need a decreasing term policy for that debt, that's called credit life insurance. We got it?
Yes.
Cool.
Yeah, I got it.
Cool. Okay. Do we want to hear an example or we're good?
I'm fine.
Okay.
Yeah, I'm good. I understood.
Okay. So increasing term insurance. What is increasing term insurance?
Sadly, the premiums are going to go up. It increases.
Okay. Okay. So this is talking about, when it's talking about increasing and decreasing, it's mostly talking about the benefit, the death benefit. So when it's saying,
Oh, I said that wrong. I apologize.
that's okay. That's okay.
I did that on the test too.
There's our timer, but we'll talk about this and then we'll go on a little 10-minute break. So when it's talking about increasing and decreasing, it's talking about the benefit. So you're decreasing benefit or you're increasing benefit. So it provides a death benefit that increases over time, either by fixed amount or percentage. A quick reason of why someone would do this or why someone would use this is, hey, I'm getting older and, you know, maybe my mom was diagnosed with early onset dementia. Okay. So I'm going to need, you know, more and more coverage over time. Okay. That could be a reason. You could probably think of another, 10 other reasons why someone would do it. Here's another example. So Lisa purchased a 10-year increasing term life insurance policy with initial face value of 100,000. Each year, the face amount increases by 5% of the original value. So after 1 year, the coverage amount becomes 105,000. Okay. And after 2 years, 110, and so on and so on. So it offers more protection as time goes on. And also, that could be if you are working. Let's say I'm early on in my career and I, am starting to make more and more money, which means, I'm buying more and more things, maybe a bigger house, maybe a bigger car. So I would want a bigger and bigger death benefit as I continue to grow my portfolio and as I continue to grow my monies, right?
Correct.
All right, so let's go ahead and take a 10-minute break. I'll see you guys back here at 3:17. Let's
You're
just
correct.
3:20.
Yep.
Yeah.
Cool. All
Okay.
right. See you guys back soon. All right.
I'll be right there.
Okay. We are in the home stretch.
Yes, we are.
1 hour left. Woohoo! Biggie is, I wish I could show you guys what he's doing, but he's like face planted against the wall right now, or against the
Aw.
yeah, he really wants to come in. He's okay. He's swimming around. Okay, let's see.
He looks so healthy. He has a beautiful coat.
Thank you.
Yeah, he looks very healthy.
He's a spoiled boy, I have to say. He's a spoiled boy. And whenever I bring him home, I'm home for parents or for Parents Weekend. I'm home for Mother's Day tomorrow.
Mm-hmm.
I came home to visit my family, and whenever he's here, he gets like the specialist treatment. I mean, he is, if that's even a word, he gets treated like a king. My parents make him chicken, turkey,
Oh, that's
everything.
nice.
Oh yeah. So then we go home and he doesn't want to eat his dog food. Like, really, you had to do that? And they're like, he loves it. I'm like, I'm sure he does.
That's sweet.
I'm sure he does. Everyone loves some good turkey and chicken and
Absolutely.
ham, lobster. I mean, you name it. He gets it all. Look, he's upset. Okay. All right. So did we do convertible term policy?
No, we didn't. We left off on that.
We left off on this one. Okay.
Mhm.
Give me 1 second.
Sure.
Let me just go get him from outside before he drives us crazy. Let's see. How do I? Found a lizard. I think he found a lizard. He's distracted again. Okay. So play from current slide. Okay. So convertible term insurance. What do you guys think?
Gives the applicant insurer, excuse me, the opportunity to convert their term policy into a whole life policy without proving insurability.
Good. Good. So a type of term life insurance that allows the policyholder to convert the policy into a permanent life insurance policy, like whole life or universal life, without having to provide evidence of insurability, such as a medical exam. So you got that exactly right. Can they, let's see how I want to word this question. Actually, I want to wait. I want to wait to ask that question until we get to something else. Okay. So are we good on this one, or should I explain the example?
I'm okay on it.
I'm okay.
Good. All right. Renewable term insurance. What is renewable term insurance? No.
I just read that
Sorry.
one too. That's policy that's able to be renewed at the end of the period that it's originally insured for.
Okay. You're right. I'm letting him in. You want to come up here? You want to say hi? Okay. You say. So I was being very, very annoying outside. Let me see. Come up here. Come up here. Can you see him? Can you guys see? Oh,
Yes, we
he
can
does
see
not
him.
want to come in. I've done that. Okay. All right. You're stinky. Go somewhere else. All right. Renewable term insurance. Tell me it again, just because I was listening, but I was a little occupied as well.
That's a policy that's able to be renewed once it reaches the end of its term.
Perfect. That's exactly right. So it guarantees the right to renew the policy after the initial term expires without requiring proof of insurability. Okay, so it kind of rides along the same lines as the last term that we discussed. So all term insurance policies have a final termination date after which renewal is no longer possible. Okay, so renewable term insurance you can get that, but there is an end date to everything. Okay. Are we good on this, or should we do an example?
I'm good.
Okay. Annual renewable term insurance.
It renews every year, and you don't have to prove. You know what? With this one, let me ask you this.
Mhm.
Now it says without providing evidence of insurability. I kind of get this a little confused. And the reason why, because in my mind, you should have to, I mean, I'm not telling the insurance company what to do, but you should have to prove it in my mind because you're getting older each year. But it says without providing evidence of insurability. But the main thing is that it renews every year.
That's the main thing. The
Yeah.
main thing is that it renews every year. What the insurance companies decide to do and how they do it, I have no idea. I have no idea why. I don't know the rhyme or reason, but I know that they still take into account, well, I can't even say that because some of them don't. But yeah, I don't know the rhyme or reason why they do, but it's essentially an add-on that you can get in a way. So it does cost more to do this. So I guess that could be a reason why the insurance companies do it. A little extra way to make some money.
Understood.
Are we good on this or should we do an example?
I'm
I
okay
think we're
on it.
good.
Good?
Yeah, I'm good.
Good. Term rider. What is a term rider?
That's a addition to a policy
Good.
or
Yeah.
add-on.
Yeah, an optional add-on to a permanent life insurance policy that provides additional term life insurance coverage for a limited period of time. Okay, so you can have a whole life insurance policy, but you can get a term rider on it. Okay, and say, I want additional coverage between the ages of 40 and 50 because that's when my grandmother got whatever. Okay. So you can add, again, for an extra cost, you can add a term rider on it. Are we good on this?
Yes.
Perfect. All right, whole life insurance.
It covers you for your entire whole life. It endows at the age of 100. It has a safe, a component of a savings to it, cash value, and it builds cash value.
Good. Those are all right. It builds cash value, terminates at 100. You get everything back when you're at 100. Okay. It's the entire life. Okay. What else? What else can we think about whole life? There's so much to whole life. There's cash value, there's living benefits, right? Cool. All right. Are we good on this one?
I
Yeah.
am.
Sweet. Types of whole life insurance. All right. Straight life insurance. Straight whole life insurance. So this one, premiums are paid for the duration of the insured's entire lifetime. Okay. So with coverage continuing until death, in other words, premiums are payable for as long as the coverage remains in effect. Okay. So the premiums are level. There's a consistent death benefit and with a cash value accumulation. Okay. So it also mandates that the insured to be paid the face amount upon reaching 100 when the policy reaches maturity. Do we know what maturity is?
What do you mean?
100.
When it endows 100?
Yeah, so when it endows, yeah. So when the policy is pretty much done, when it gets to its, when it's matured. Okay. If a death benefit has not already been dispersed. So we talked about that, where if you reach 100, you get all your premiums back. Okay. Whole life, straight whole life, the whole idea of it, the only thing that you guys really need to remember about it, is that you pay premiums, stable premiums, okay, level premiums your entire life. So you're paying them straight through your whole life. Good?
Yes.
Sweet. Whole life limited pay insurance.
Is that the one where you pay premiums only for a specified amount of time?
Good. Good. Limited pay. Okay, so all of these have to do with how you're paying and when you're paying your premiums. Okay, so whole life limited pay means you're only paying for a limited amount of time. Okay, so you can purchase a 10-pay policy. Okay, it's not going to say, this used to trip me up too. I'm like, why doesn't it just say 10-year pay policy? Nope, it's just going to say 10. You have to assume that it says year after that, but it says 10-year pay policy. Okay, so for the first 10 years or however, long, I'm going to be paying into my insurance. And after that, I'm not going to pay anymore. Okay. So let's say I want to retire at 65. So I'm going to pay for 10 years from 55 to 65, and at 65, I don't want to pay any more premiums. That would be a limited pay insurance. Your premiums would probably be higher, right? Considering you're only paying for a certain amount of time, but it also depends on the amount of death benefit that you want.
Correct.
Good on this?
Yes.
Yeah.
Sweet. All right. Whole life modified.
I don't know that one.
I think that's where you have a whole life, but isn't it only when it's modified, it's only either you take stuff out of the policy that you don't really think you're going to need, and that it's only for a certain time duration? I can't remember.
See. No, that's okay. That's okay. I like where you're going. So modified, all we have to do is think about how people usually pay premiums, right? Premiums are usually paid on a yearly basis, a monthly basis, a semi-annual basis, right? Things like that. So a modified version of that is going to be something that they, for the first 5 years, they're paying a premium that remains about the same. And then on the 6th year, it increases and then stays level for the rest of that. Okay, so the first 5 years
I
are going to be
remember.
different than 6 and the rest.
Okay.
Are we good on this?
No.
Yeah, I remember Justin going over that in the slides where it goes for a certain term, then goes up and then stays level. Okay.
Yeah.
Yeah, because he drew a little diagram about it. Now that's coming back
I
to me.
remember his diagram.
Yeah. Okay. So, and the reason is that is because it makes it more affordable initially, right? So like I'm younger, I don't have as much money. So the first 5 years, I want to be paying a lower premium. Once I'm, 5 years after that, I'll be in my career making money. I can pay higher premium. Okay, so let's do an example. Emily, a college student, purchases a modified whole life insurance policy. For the first 5 years, her premiums are lower to fit her budget. After this period, the premiums increase and stay level for the remainder of the policy. This option allows Emily to benefit from a whole life insurance policy while paying reduced premiums during her college years. You good on this?
Yes.
Yeah.
Whole life modified endowment contract, a MEC, an MEC.
Yeah, that's that 7-pay test. But that's the only thing I remember out of it, but I really need to understand it.
Okay. So let's talk about it. So it exceeds the IRS limits on the amount of premium that can be paid into the policy while still being considered life insurance contract.
Yeah, wasn't it implemented as far as the MEC for anti-money laundering purposes. So people couldn't just dump a bunch of cash into a life insurance policy and then say, I don't want the policy anymore, give me all my money back.
Exactly. So we still have, that's exactly right. We still have rules and regulations based on how much we're contributing. Yes, we can still choose, hey, I want to contribute this amount, monthly. I can contribute more or less depending on, my agreement with them. But the idea of this is that, hey, let's cap this at a certain amount. So in the first, the 7 pay test, remember, they don't really like to use the word years for some reason. So it's supposed to say 7 years pay test. Okay. So it fails to meet the 7-year pay test, which ensures the policy is not overfunded. So in the first 7 years, if I'm giving it so much money, it overfunds it. Okay. Then that is considered bad and we'll call it a MEC. Okay.
Now here's
Yeah.
my question. I know that the MEC, like I said, was meant to hinder money laundering. What's to not allow people to do that with the lump sum annuity where they just dump money in and they have to start taking payments within the first 12 months? Like, couldn't that be used as the same kind of cash vehicle as the ones that are deemed not to meet the 7-pay test?
Yeah. So you're exactly right. That's a great question. So every policy has its own restrictions, right? So that policy would be a little bit different. Obviously, if we're doing a lump sum payment, that's going to be a little bit different because obviously we're giving it a lot of money. But I think now, I want to say that it's based on the amount of benefit that you're getting versus the amount that you're paying. Okay, so if
Okay.
I'm paying a lot more than the benefit is going to give me, then that's the issue. I don't think it's necessarily the issue in the sense of what you were saying, where, oh, I'm paying all this money straight ahead. That's fine because we have those policies that are lump sum. But I think it's more based on if I'm giving this policy, if I'm funding it way more than the benefit is going to give me, then that's not where we want to be. Does that make a little bit more sense?
It does.
Yeah.
Okay, cool. So let's go over an example. So Jamie buys a whole life insurance policy and pays $15,000 in premiums over the first 5 years, with an annual premium of $2,000. Since Jamie has paid a total that exceeds the $14,000 limit, 7 years times 2,000, right? So the 7-year pay test, the 7 pay test. So we take the annual premium. This is what I was talking about when it's based on, instead of the amount that you're giving all at once, it's based on how much you're giving compared to the benefit. Okay. So the first 5 years, she's paying $15,000. Okay. But the annual premium cost is $2,000. So in 7 years, she is going to be giving $2,000 each year, which means the total that she should have funded that is $14,000. If it goes over $14,000, that exceeds that limit. Okay. And then that's considered a modified endowment contract.
She overfunded it.
She
Okay.
overfunded it. Does that make sense? So based on annual premium times, so the annual premium times 7.
Right.
Are we good there?
Yes.
All right, cool. Joint life policy.
This is a policy that will pay when the first is to die. Oh, excuse me.
Okay.
Right, okay, I was right. And when I saw 2
Yeah, you're
individuals,
right.
I'm like, I'm saying, it didn't say survivor. Okay, yeah, this is a policy that pays when the first is to die.
Good. Good. Okay. So a joint life policy, joint. So I'm buying it for me and my spouse. Okay. So we're buying it together. It reduces premium costs by averaging my age. So let's say my spouse is 30 and I'm 28. Okay. So it's going to average our age. We're going to be 29. All right. That sucks for me because I'm younger and I would get better policy rates, but that's fine. Whatever.
Mhm.
Okay. So it reduces the premium costs, okay? Because between the two of us, we would both be paying premiums if we didn't do this. So essentially it would be lowering the premium costs. So the policy pays out the face amount upon death of the first insured person. Okay. So if one of us dies first, then the other person will receive the death benefit. That's joint life. Joint life, one goes away, this one receives the benefit. Good here?
Correct, yes.
Yeah.
All right. So Alex and Taylor purchased a joint life insurance policy. The policy covers both individuals and offers a lower premium by averaging their ages. If Alex passes away, Taylor receives the full death benefit and the policy terminates. With Taylor no longer being insured under that policy, this type of policy pays out the face amount upon the death of the first insured person. Joint survivor or last survivor life.
Oh, that's where the policy doesn't pay out until the second and the joint policy passes away.
Correct.
Good. Covers 2 individuals and reduces premium by averaging their ages at the same as joint life. But unlike joint life, this one only pays out the death benefit after the second insured person dies. So this benefit, instead of going to the other person in the joint life, it goes to the beneficiary. Okay, so it covers 2 people's lives, but only pay the death benefit upon the death of the last insured individual. Okay, so they purchased a joint life policy. The policy covers both people, but the policy is only paid out after Jordan and Casey die. All right, family income policy.
This is when the policy would pay in the event of death for the entire family.
Okay. So family income policies. So let's think about it more in the sense of income. So
Oh, okay, I see. Thank you.
that's okay.
It's an income that would continue on, not only for death. If I'm not mistaken, it does it for if a family member is disabled too, correct? Or no?
Okay, good. So family income policy provide a regular income starting from the insured's death and continued for a predetermined period after the policy's issuance. Okay. So you said a little bit of everything in your no, it's okay. What yeah, you said it correctly. It was bits and pieces from both things that you said. Okay. So it's from the insured's death, and it's pretty much to continue to provide for the family income. Okay. So let's say me, my spouse, and my kids, we rely on my spouse's income. Okay.
Mm-hmm.
So let's say that he dies, but we have a family income policy. Let's say he makes 70,000 a year. Okay. This will still provide for us for a predetermined amount of time until maybe I can get on my feet and get a job or something like that. Are we good here?
Yes,
Yeah.
now I am.
Perfect. All right. Adjustable life policy.
This is when it is flexible. You can adjust the premiums. You can adjust when you want to pay. It is a whole life policy. Very flexible.
Very flexible. Okay. Adjustable life policy. So they want more flexible premium options. Okay. So this is more specifically talking about premiums. Okay. So they want flexibility in when they're paying, how they're paying, how much they're paying, things like that. So they can also, another big thing on adjustable life policy is they have the ability to adjust the death benefit. Okay. So according to, more needs or less needs. So let's say I have a child. Okay. I want to adjust my life policy to be bigger because I now, if I die, I need the finances for my child, right?
Correct.
Okay. So they usually do not include dividends. And if the policyholder wishes to increase the face amount, they may need to provide proof of insurability. So here we go with the same example. If you're experiencing fluctuations in income, okay, that's another great reason. Let's say I have my own business, and in the beginning of my business, I need a lower premium. And then as my business grows and I get, more monies coming in, then I can pretty much make my premiums higher to accommodate for that higher income. And obviously I'm getting more benefit from that. Are we good on this?
Yes.
Cool. Universal life insurance.
Sub policy that not only has insurance, it has a cash component to it as well.
Good. Perfect. Universal life, that's the biggest thing, cash value. All right. Features the ability to adjust both premiums and the death benefit. Okay. Investment gains from the policy are typically allocated to the cash value with the policy owner, which the policy owner can use to manage flexible features of the policy. So what it means by that is, let's say I have a rough month and I can't pay for my premium that month. I can ask them to take from my cash value and pay for part of my premium that month. Okay. Does that make sense?
Yes.
Cool.
Yes.
Okay. So people who want the most choices and control over their policy, it's flexibility in both premium payments and death benefits. Let's see. So we're good here. Universal versus variable life insurance. So that's actually not what's compared on this page at all, but that's totally fine. This one compares universal and adjustable. That's totally fine. Okay, let's compare the two. All right, so adjustable, the flexibility is moderate. Universal actually has more flexibility. Okay, the investment risk on the universal is the policyholder. The investment risk on the adjustable is the insurance company. Okay, if you want a lot of coverage, if you want a lot of flexibility, I would use the universal life over adjustable. Even though adjustable has a good amount of flexibility, universal is the most flexible. Are we good on this?
Yes.
Yeah.
Cool. Variable life insurance.
This is when the policy is tied to investments.
Good. Good. Variable life insurance, exactly what you said, known as interest sensitive policies. They feature a fixed premium, but their cash value and death benefits can change depending on how the underlying investments perform. So you're really hoping for good performance if you have to use that policy, right?
Correct.
I really hope this year was good, right? That's bad. I'm sorry. I didn't mean to say that, but sorry, y'all. It's not about money. It's not all about money. But okay, so there we go. Ideal for those looking to offset inflation, as these policies allow for potential growth. However, the policy owner assumes all the investment risk and returns are not guaranteed. If Alex is interested in a life insurance policy where the cash value and death benefits may vary with performance of investments, like mutual funds and stocks, he should consider a variable life insurance policy. Okay. Oh, wait, that was a good little thing. So returns are not guaranteed. Another thing to note in that. Variable universal whole life.
I've been doing the talking, y'all. Somebody else take it.
That one I'm not sure of. These are where I always get hung up.
Okay, let's talk about it. So it blends features of variable and universal, obviously, because that's the name, right? So it enables the policyholder to manage the investments where the cash value are invested, as well as make adjustments to when premium payments are made and how much they are for. Okay, so it essentially combines the two. Okay, so if you want full control over your policy's financial aspects, including selecting which investment accounts to fund, when premiums are paid, where investment returns are allocated. Okay, so this one is like the big guy. Okay, it's the one that you can pretty much have a lot of control over. Universal, we already know that that's one of the most flexible ones, right? Variable universal, now we have even more flexibility because now we're saying, hey, we're in charge of the investments as well. Are we good here?
Yes.
Yeah. Yeah, now I understand it better.
Perfect. So Emma wants a life insurance policy where she can control not only the timing and amount of her premium payments, but also how her cash value is invested. Choosing between various investment accounts like mutual funds and stocks, she should consider variable universal life. Or VUL. Okay. Equity index universal life. Equity indexed life insurance.
Is that one that's based upon investments made like in the S&P 500 that goes off of a variable index?
Perfect.
Perfect. Yes. Excellent, Will.
Thank you.
You're
That's
welcome.
exactly right. That's exactly right. So, it exactly right. So, okay, so NASDAQ 100, S&P 500, anything like those are all things that you could invest when you have an equity index universal life insurance. Okay, so 80 to 90% of the premium is allocated to traditional fixed income securities, while the remaining 20 to 10% is invested in contracts linked to specific stock index, NASDAQ, S&P 500, all of those, okay? Offers guaranteed minimum interest rate tax deferred interest accumulation. What is tax deferred? What does that mean?
That means that taxes will not be taken out until there's a withdrawal on the interest.
Good. Perfect. Tax deferred. They're deferred till later. We're not worrying about it now. We'll worry about that later. Okay. That's another thing to consider with like Roth IRAs, things like that. The tax deferred accounts, when you have, so the benefit of having tax deferral before putting it into an investment is that so that means you would pay when you take out of the investment. Okay, so the benefit of that is that now you have more money to invest, to save, things like that, because you're not getting taxed initially, but you will get taxed on the back end. Roth IRAs, things like that, where you get taxed in the beginning and then you don't get taxed on the back end of that. What's really cool about that is that you're essentially just growing a bunch of money, and whatever you see in that account is exactly what you can take out. And you won't get any.
Okay.
Cool. That's why they're
Yes.
telling you, like, Roth IRA, because when you take it out, you're all good to go. Cool.
Yes.
Sounds good.
Sweet. All right. So we're good on this one. Okay. Equity index universal life versus variable universal whole life. Okay. So we kind of talked about this before. One of them, so equity index life, equity index universal life is more tied to stock index, S&P. Those are the big ones, S&P 500. You know, yeah, all of the big ones. And then the variable universal whole life are more mutual funds. Okay. So the risk changes on both of these. Okay. When it's the variable universal whole life, there's no floor. The risk is very high, versus the other one is a little bit lower. And then again, I'm not going to read through all of this, but you guys can kind of see the differences. Think of equity index universal as kind of a more stable version of the variable universal whole life. You good on this one?
Yes.
Yes.
Okay. Investor stranger originated life insurance policy.
I get this one mixed up, but I think I'm not for sure. That is when you give it to someone, your life insurance policy to someone else. I'm not really clear on this one.
You're right.
It's something like that, because it just didn't make sense to me. But anyway,
you're on the perfect path. You're on the right path. Stranger danger, giving it to a stranger. Okay. So an investor benefits financially from the death of the insured rather than a beneficiary. Oh, sorry. I don't know why I keep doing that.
It could be me. I'm not sure.
Okay. Sorry about that. All right. Okay, so going back to what you were saying, so stranger danger, right? Remember we talked about you have to have insurable interest?
Correct.
So this is kind of a way to go around that, okay? Unfortunately, there are always loopholes in everything. That's why new rules, new policies, new things are created, because people find the loopholes, okay? So think of this as kind of another loophole around that. So an investor, so I would benefit if I buy a life insurance policy on my neighbor down the street, which I don't really have an insurable interest on, okay? But I buy a life insurance policy on her and she passes away, okay? I would benefit from that, right? But I don't have insurable interest. So again, this is kind of that loophole to get through that. Okay, so this arrangement involves the investor purchasing a policy on another person's life with the intent to profit from that person's death. The investor becomes the policy owner, the payer, and the beneficiary. Okay, So let's say my neighbor needs money because she just got diagnosed with cancer. I'm sorry that all of these are really terrible, but this is kind of what I'm thinking about. I'm not thinking about all these bad things. I'm sorry. These are the best examples to give. Unfortunately, life insurance and insurance, the examples aren't always the most happy times in
Right.
people's lives. So
Right.
I don't mean to be so depressing when I talk about these examples, but it's the best way to express them. Okay.
Correct.
So let's say my neighbor down the street gets diagnosed with cancer. Okay. She has a $500,000 death benefit. Okay. I can go over there and say, hey, I'll buy this from you. I'll buy the rights to this essentially so I'll buy this from you and I will give you $300,000 that you can use right now. I will give it to you right now if you sign this over to me. Does
Yeah.
that make
Just
sense?
sounds so, ugh, yeah.
It's illegal. It's okay. It's
Yeah.
illegal. It's a loophole, but it's an illegal loophole. So don't do
Yeah.
it. Okay. So they bypass the requirement for insurable interest, right?
Mm-hmm.
Okay. So if Alex, an investor, purchases a $100,000 life insurance policy on Jamie, the insured, and names himself as the policy owner and beneficiary, Alex would receive the $100,000 benefit upon Jamie's death. Jamie, in exchange for allowing this policy, receives $500 a month. This type of policy is known as investor originated life insurance. I like to add in stranger in there because stranger.
Right.
Um, it is illegal because it bypasses the insurable interest requirement. Okay,
Mm-hmm. Yes.
cash value.
That is what is built up in your whole life policy, cash value.
Good. The
Mm.
accumulated equity or savings within a whole life insurance policy.
Oh, as
That's
Justin says in his course, it is a savings component.
There you go. It's a savings component. I love it. All right. You can take that out in different ways and use it in different ways, right?
Mm-hmm.
Cool. Endowment policy.
That's a policy that pays out once the person reaches their age of 100, isn't it?
Okay. So accounts for payment of the face value at the end of a specified period.
Oh, sure.
Upon reaching a certain age upon the insured's death before a specific period ends. It makes it so the benefit is paid in every legal circumstance. Okay. So endowment is pretty much like make sure I get my money, make sure my family or someone gets the money, right? So John purchases an endowment policy with a face amount of $50,000. The policy specifies a maturity period of 20 years. If John is still alive at the end of 20 years, he will receive $50,000. If he dies before the 20 years are up, his beneficiary will receive $50,000. Make sure my money goes somewhere. I'm not
Right.
buying this policy without it going somewhere, right?
Right.
Cool. Face amount plus cash value policy.
Someone else can take it. I've been talking.
Uh, that one I'm not sure.
Okay. So face amount plus cash value policy guarantees a payment that includes both the policy's face amount and an additional sum equivalent to the policy's cash value upon the insured's death. So this is kind of like another rider in a way that we can add on.
Mm-hmm.
That at the time of death, I get the cash value and the face amount.
Yeah.
Okay. So Sarah has a life insurance policy with a face amount of $30,000 and a cash value of $5,000. If Sarah passes away, her beneficiaries will receive a total of $35,000, which includes both the face amount and cash value of policy. If someone's getting this, do you think their premiums are higher or lower?
Higher.
Higher,
Yeah,
right?
probably
Yeah.
higher, yeah.
Yeah.
Right.
I
Because
mean, look at what you're getting.
Right.
Yeah.
Exactly. Exactly. Okay. So Right now it's 4 o'clock your time, 5 o'clock my time. We have about 30 minutes left. I can continue on this and we can continue going through, or you guys can pretty much ask me any questions that you guys have. We can discuss things, talk about things, or you guys are like, hey, I'm done. I don't want to learn anymore. My brain's tapped out. I'm done. I want to leave this time up to you guys and what you guys want to do. If someone is like, hey, I'm done, and another person wants to ask questions, I will still be on here until 5:30.
Let me ask you this, are annuities and taxes included in this?
Yes, they are. Should we
Okay.
go? Do you want to go through those?
I just want to take a 5-minute break and then we can resume. That's what I would like to do, but it's up to everybody else. That's just my recommendation.
Okay. How's everyone else
I'm good
feel?
with Karen's
I'm okay with
recommendation.
it.
All right. I'll see you back in 5 minutes.
See you guys. All right. Hey guys.
Hello.
All right. So last 25 minutes. Do you want to go over annuities?
That'll be great.
Heck yeah. Okay. So we can go over annuities and then kind of just cover any questions that you guys have about the exam or anything like that. Just until then.
Sure. Sounds like, oh, look who's
There's,
behind
there's
you.
my dad.
Hey,
Hi.
I'm Juliana's dad. Is she doing
Nice.
Hello.
is she doing a
Nice.
good job?
I'm sorry.
Is she doing a good job?
Excellent job. You
Oh,
raised
that's
her
all I
well.
like to hear. Awesome. I love the background.
Thanks. All right. So let's go over annuities, okay? Will, are we okay with that as well?
Yeah.
Okay, sweet. So annuity. What is an annuity? Can someone explain it to me, or do you want me to run through it?
I can explain it. An annuity is, I'm going to use Justin's example. An annuity is you have a lot of money. You really don't want to have that money just sitting around. You want to give it to the insurance company and they distribute it
Oh,
however you want it to be distributed.
wow. It's like, here, give it. I don't need it, right? You take it. I don't want it. Is that what happened?
Exactly.
Okay, so I love your example. It doesn't have to be a lot of money, okay? It can just be money. So annuity, think of annual premium for you, okay? So annual finances for you. So an annuity is just any money that, again, you're going to give to the insurance company, and they're going to pay it to you in certain amounts and in certain periods based on how you want that to be given. Okay, so that could be, let's say you set up an annuity for your son or your daughter. Okay, so let's say I passed away and I have a son. Okay, I'm gonna set up an annuity. Okay, sorry, I'm gonna set up an annuity. And I have, let's say, savings of $300,000 that I want to give to my son over the next 10 years. I'm gonna have the insurance company break that up and maybe even invest it. Okay, so he continues to create finances for an allotted number of time until my money's run out. Make sense?
Correct. Yes.
Yeah.
Cool. Okay, so Karen, what other questions do you have about annuities, or do you just kind of wanted to run through that definition again?
Oh no, I just wanted to be a part of it. I'm getting better at it, so I totally understand. I was getting a little confused about the fixed period, but I do understand that now. So no,
Cool.
I thought there were some questions with it like the other ones that we could go
Okay.
through.
Yeah. So we can I have it on here. Let's see. Um, um okay. Um, am I sharing my screen or no?
Not yet.
Not yet.
No.
Okay. Let me go ahead and share my screen. And then we'll go through this.
Because a very wise person told me repetitiveness is the student's glue.
Is the students, what was that?
Glue. Like the
Blue.
more you repeat it, the more it will stick with you.
That's exactly right. And also teaching, right? I think
Mm-hmm.
teaching can kind of add to that. So just seeing it, teaching it, relearning it,
Mm-hmm.
you're exactly right. Okay. So let me go ahead and share my screen. So, now let me ask you guys this. Do you guys want me to continue to share it in this way? Or do you guys want me to go through the Kahoots and we can go through all the chapter Kahoots and kind of see everything?
Oh, I like to do everything.
Would you guys want to do
Right.
that?
Yeah.
Okay, so let's do that. Let's go through all the chapter Kahoots. And then we'll do some questions at the end. Let's see. See if Kahoot's gonna work for me. So we're on chapter 4. Do this, share. Oops, not assign. Okay, how did we do it? Learn, I think was the one. Why is it not going up there? There we go. Can I zoom in? I had it zoomed in. Okay, so which policy provides a level face amount and renews annually without new underwriting?
Annual renewable term
Mm.
insurance.
We good on that one?
Yep.
Cool. Yay. Uh-oh, there's music. Sorry, y'all. Do you want me to try to get rid of that?
Oh, I didn't even hear.
I didn't hear it either.
Just on my end. All right, that's fine. Okay, term rider policies allow whole families to be insured under one main policy. True or false?
Mhm.
Mm.
Yes?
I'm reading the question. Term rider policies allow whole families.
Oh no, that's false.
Yeah.
False?
I'm gonna say false.
Okay.
Yeah.
Are we
Yeah.
agreeing on false?
Yeah.
Yeah.
But I mean, look at, is it just me? Look at how that term rider policies allow whole families. I mean, what's
I
a
thought
whole
the term
family?
rider was just short term, but
Does anyone not see that but me?
Mm.
no, I was
see it.
looking at it the same way, but I was wrong.
Okay, so let's talk about it, right? So
Yes.
term rider policies allow whole families to be insured under one main policy. Okay, the answer here is true, but I see where you guys are getting a little bit confused because it's like, well, doesn't it depend on what you're buying, what term, what rider, right? So yes, but under the main idea of what a term rider policy is, it allows the whole family to be insured under one big policy.
Okay.
I know it's a little bit of a
Okay.
stretch. I hear ya, but it's still a general true.
Okay. As long as we pass the test, it's fine. That's my main objective. So it's
Right?
okay.
As long as we
Right?
pass it. I hear ya. I hear ya. Okay, let me do this.
I guess I wouldn't put the whole family. I mean, when you say whole, I'm just thinking about whole life insurance. I mean, I don't know. Maybe it's just my mind.
Okay,
What
so
makes a family whole? I mean, maybe it should say entire families to be insured, or I don't
and
know.
that's what it means. It means entire family.
Yeah.
Okay. So, so let's talk about term rider. Does anyone remember the definition of a term rider?
You can add it to a whole life policy.
Okay, so it's an add-on, correct?
Mhm.
Okay. So a permanent life insurance policy that provides additional term life insurance coverage for a limited period of time. So technically, yes, the whole family can be insured under that policy.
Okay, that's
Have to
fine.
be? No. Can they be? Yes. That's why this question is a little iffy.
Maybe it should have said at the end that they would be covered under one main policy for a specific amount of time. Because it does have a term to it.
It
So the
does have,
term is going to run out.
Correct, Will. I agree with you.
that's
So I think
exactly
that's probably where it would have been a little less confusing because it made it sound like it was a term rider was being added as like a whole life policy
Correct.
instead of being for a specific
Period of
amount of
time.
time.
Exactly. You're correct.
right. Okay, I hear you. So we can make that adjustment to this. But it's talking about whole families, as in an entire family, not a whole life
Right.
policy. But we will make that. I'll make an edit to this one because I totally understand how this is a little bit confusing. But term riders allow for the entire family to be covered under a single policy. So that is true.
Thank you, ma'am.
Okay, which life insurance policy is paid for over the insured's entire life and provides level premiums?
Whole life, straight life.
Great. Yeah, whole life, great life. I agree.
Woo-hoo!
Are we good on that one or should we do some explaining?
I'm
And which-
okay.
I'm okay.
Okay. Everyone's good? Okay. What type of policy provides a lower premium for the first 5 years, then increases in year 6?
Whole life modified.
Everyone agree with this?
Yeah.
Yes.
Modified version. Cool. Oh, did I skip one? No. Okay. Joint survivor policies start paying out when an individual passes away.
No, that's a trick question.
Sure.
It doesn't say which individual. False. Oh, wait a minute. I'm sorry. Let me be quiet. Joint survivor start paying out. Individual is the first. But that's kind of the way that's worded. But let me be quiet. True.
What does everyone else think?
I
I
agree.
think
I
true.
agree with
We're
Karen.
going true?
Yes.
Yeah.
It should
Oh.
see, I went with false at first. That's the way
the
that was
survivor.
worded.
Yeah.
Joint
It's not
survivor.
until the Viper. Yeah.
See, this
Yeah.
make me want to hush.
What was that?
This make me want to
Yeah,
hush
both
because
individuals.
I be so unsure of my answers.
That's okay. That's okay. This is what this whole thing is for.
Yeah,
We're gonna
that's
make
a
it
little
better.
tricky. I should have
It's-
just stayed with false.
That's okay. So, someone tell me what a joint life policy versus a joint survivor policy? What's the difference between the two?
The joint life policy pays when the first person in the policy passes away. The joint survivor policy doesn't pay out until
Second.
both of the people in the policy pass away.
Good. Good.
Yeah.
Okay. So, when an individual passes away, the answer is no.
Correct. All right. Who wrote these questions?
I hope she's not helping make the test, otherwise we're in trouble.
I'm not. These questions are a lot more difficult, a lot more challenging than the test questions. The test questions will be a little bit straightforward. You will have some that will throw you off. So again, take the questions, take the exams that he gives you because those are going to be very similar, but don't memorize. Remember to read each question.
Understood.
Okay, so what is the primary reason for someone who would choose an adjustable life insurance policy?
The yellow, to have flexible premium and death benefit options.
We agree on this one?
Yeah.
Cool. Correct.
Hoo-hoo, you didn't trick us.
Not this time.
Yes.
Yeah, right. Variable universal life allows the policyholder to adjust both premium payments and investment options.
True.
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 Yeah.
Ooh, we're on a roll. I skip one. No. Okay. What determines the changes in cash value and death benefits for a variable life insurance policy?
Performance of the underlying investment, the yellow
Yeah.
square.
Are we all in agreement on this one?
Yeah, I agree on that one.
Woohoo!
Woohoo!
Okay, which life insurance policy includes a guaranteed minimum interest rate? Tricky, tricky.
That is.
Yeah.
Maybe
Just
paying
let me
attention.
give me a second to think.
Okay.
Is it term life?
No.
No, it's not term. Which life insurance product is a guarantee?
Okay.
I'm going to go with the yellow square.
Okay. Anyone else, or are we?
I think it's
I'm
the
not
red
sure,
one, but
but
I think I'm
I
wrong.
would second to that one if it wasn't.
Okay, let's go with this one. Correct. Woohoo!
Oh,
Woohoo!
good job.
Okay, so let's talk about it. Okay.
Yes, let's talk about it.
Which life insurance policy includes a guaranteed minimum interest rate? So at the end of the day, I know that I'm receiving this much.
Mm-hmm.
Okay. Term life, why is it not term life?
Because I mean, that's just for a certain period anyway. It's
You
not
don't get benefits.
right, right.
It's a specific amount it's a term, it's for a set period, so you don't really get any extra benefits for it. Okay.
Right.
Variable life, it does have to do with investing, but why is it not variable or universal?
It's fluctuates.
Fluctuates.
Yeah, on the market performance.
Fluctuates on the market performance. So what is so special about what we're investing in the equity index, universal life versus variable life?
Well, if you're gonna get that technical, I'm just teasing. I mean, you're gonna get that technical.
If you guys understand this,
I
it'll
know,
make
I'm just teasing. I'm just trying to make it light. It's tied into the S&P performance.
Good. Okay, so the S&P performance usually over years goes up, right? Because it's investing in the top 500 companies. Okay, so we can assume that it's always going to go up, 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 up. Okay, so that's why with that one, you're going to get a minimum interest rate because we know we can assume for the most part that one usually goes up. Okay, variable life, universal life, we don't really know because you're investing, who knows what, and we don't really know what's going to happen with that. But for equity index, we're investing in a bunch of the top companies. So we know that they'll probably do well, right?
Absolutely.
Cool. Did that actually make sense to you guys?
No, it did. Seriously, all
Yeah.
jokes aside, it did.
Okay, good.
No, it did really.
Yeah, it did.
Good. So what is a key reason investor-originated life insurance policies are considered illegal? And remember, we're forgetting a little word in here that will help you. What is the word?
Illegal. It's the blue square. They
Okay.
violate insurable interest requirements.
Okay, what does everyone else think?
Yeah, I agree.
Okay, good. So the key word that I was thinking about, ready? Stranger. Remember stranger danger?
Oh, I'm sorry. I went with illegal. Excuse me.
Hey, that's okay. Stranger danger. When we look at that, think about stranger danger. Okay? Cool?
Yeah.
Yay, team.
Yay, team. Okay, let's go through chapter 5 now. So this one might be a little bit more difficult because we didn't really go through. Let's see, is it learn? Okay. What does an absolute assignment do in a life insurance policy?
The yellow square transfers full ownership and rights to another person.
What is everyone else?
I
Are we
agree.
going with that 100%?
Yeah.
Yes.
All right, so that's exactly what it does. Absolute assignment transfers full ownership and rights to another person. Which rider pays an extra benefit if the insured dies due to a covered accident?
The blue square, accidental death rider.
Easy, right?
Mm-hmm.
I got that one. Okay, what is the purpose of the accelerated benefits rider?
The blue square, to access part of
You're on this one.
Yeah,
How does everyone feel about that?
I agree.
Good.
Mhm.
Accelerated death. Accelerated death. Oops. That's not what I meant to say. Accelerated benefit. Okay. Accelerated death is maybe part of it, unfortunately. But you have accelerated benefit so you can use the death benefit because if you have a terminal illness, that's expensive, right?
Yes. Yes.
To go around that. So you can kind of use those costs and kind of live it up the best you can until.
Yeah, and it's expensive with insurance. That's what people don't understand. It's not because you don't have an insurance, it's expensive with insurance.
Yes, it is. Yes, it is. Because you're not working.
Absolutely.
It's expensive for you and it's expensive for the people that are helping you as well.
Correct.
Okay, cool. So we're good on that. The assignment clause allows for an individual to assign a new beneficiary.
I
Well,
say true.
I'll say true.
that is so general, though.
Just trying to trip you up, Karen.
I know, Will, it's horrible. Cause allow to assign a new beneficiary. You know, because that could be, what is if irrevocable? You can't assign that anyway.
Right.
I'm going to be silent on this one. I just want to see the answer and the rationale.
Are we going with true then?
Now I'm going to go with
Yeah, that's what I'm throwing out there.
false.
Oh.
Yeah, see? Mm-hmm.
Okay, Karen, do you know why?
You
The
better
only-
explain yourself.
The only thing I can think of is because, like I said, that what if it's an irrevocable beneficiary? You can't just
Right.
assign a new
Okay.
beneficiary. You have to get written consent from the beneficiary.
Wow. Okay, I like what you're bringing in there. I see what you're saying, but it's just based on the definition of assignment clause. An assignment clause allows you to transfer policy rights to another person.
That's
So,
true too. And I read it as absolute clause. Okay, you're correct. Yeah. Yeah, the
Yeah.
answers. Yeah, okay. That
so
was my eyes. Yep, you're correct.
yeah. So the new person, if it is a revocable beneficiary, can change the beneficiary if they would like to. Okay. If it is irrevocable, what do they have to do?
You have to obtain written consent from the beneficiary.
Good. Okay. So the assignment clause isn't specific to beneficiary. It's a general thing. It transfers policy rights to another party.
Yeah, we just had that question too, you all.
Mhm.
In a different way, we just had it.
Right.
So what happens if a policyholder chooses to accumulate interest? What happens if a policyholder chooses the accumulate interest option for dividends?
Blue. Dividends are used to pay premiums.
What are we thinking? Are we going with blue? Are we doing something else?
It's between blue
I
and
say
green.
yellow.
Just give me a moment.
Yellow.
Just give me another moment. Policyholders. Interest option on dividends.
Yeah, because I just had a question like that on the test, the practice test about accumulate interest option, that it's left
Okay.
with the insurer to gain interest. Because if it's taken out, then they get taxed on it.
I'm gonna go with the green square. Dividends get refunded as premiums. To me, it's either between the blue or the green.
Okay, so we got blue, green, yellow. We gotta have a tiebreaker. Anyone want to give it a little tiebreaker or no?
No.
No.
I'm gonna go with red because that's the only one that you guys didn't say. Okay. Okay.
All right, Will.
Heck yeah. So Will, do you want to explain that?
I don't know if I can explain it completely, but as far as the question gave me an inclination of the dividends that are on the policy can be left with the insurer to gain interest, because as soon as you take them out of the policy as like cash value or something, you're going to get taxed on them.
Bingo. Will, that's exactly right. That's the exact definition of it. Okay. Accumulate interest option is exactly what it says. Let it sit, let it accumulate interest. I don't want to touch it because if I take it out, I'm going to have to pay taxes right now and I don't want to pay taxes.
Understood.
Good on this one?
Yes.
Yeah.
Thank you, Will.
You're welcome, Miss Karen.
Okay. What does the automatic premium loan provision do?
Yellow square, uses the policy's cash value to pay missed premiums.
What are we thinking?
Yeah, I'll go with yellow.
Yeah, that's exactly right. Automatic premium loan provision, automatic premium loan provision. It's exactly what automatic premiums, paying your premiums automatically. Okay, uses the premium's cash value to pay miss. Good on this one?
Yes.
Yeah.
If a policyholder chooses the cash surrender option, what happens next?
Red. They receive
Red,
the
yeah.
cash value, but the coverage ends.
Bingo. Bingo. Okay, good. Good. We understand that one, or we need explanation?
No, I
No, I'm
understand
good.
it.
What is a collateral assignment used for?
I say red.
Are we good with this one?
Yes.
Perfect. Using a policy as collateral for a loan. Okay, so hey, I will take out this loan, but if I can't pay it back, you got my death benefit. Okay. Okay. All right. So the consideration clause requires the policyholder to pay premiums and submit the application. True or false?
True.
Are we good with this one?
Yeah.
Yes.
Good. All right. What is the main purpose of a dependent rider, other insured rider?
Blue square, to
Yeah,
cover
blue.
multiple family members under one policy.
We're good with this one?
Yeah.
Yes.
Cool. Perfect. All right. That's the end. That is the end. Okay.
Woohoo! Outstanding. That's the name of our team. Outstanding.
Outstanding. I love it. All right, y'all. It's 4:30 your time, 5:30 my time, which means we have come to the conclusion of our 8-hour session. I'm so happy I was with you guys. I had a great time. If you guys have any questions, feel free to reach out. I went through the same process. I know how stressful and how crazy it can be, but you guys got it. Remember, take the exams, know the questions, and then go right into the exam. Okay.
Understood. It's been a pleasure. And I am going to email Justin and say, you know what, as an instructor, there should be feedback because you did an excellent job. But I am going to email him and let him know that. But there should be, where anytime you all teach a class, you need feedback. You really do. But I am going to let him know that you did an outstanding job. You were very engaging. You weren't stuffy. It was a very relaxed environment. It was really worth me spending my Saturday with you all. It was wonderful.
I'm so
Yes.
happy.
If you could ask Justin for me why, I know my dad does the same thing, so I'm not making fun of him in any way, but has he always said the word withdrawal the way he says it in the court? Because my dad doesn't say wash, he adds an R into the word, so he says wash. And I noticed that Justin says withdrawal.
Yeah.
So I don't
Yeah.
know if he's phonetically trying to pronounce the word, because
Oh,
if
we're
you try
calling
to
him out
phonetically
here.
pronounce it, like I said, I'm not
Bill
making
said
fun of
one
him. It
more
just
thing.
caught me off guard when I heard it, so I had to listen to it a couple times to make sure I was hearing him right. But then it made me think of how my dad says the word wash, and he says wash. So I don't know if it's just like the way he was always taught to say the word, or just something that he picked up.
I will ask him. I will ask him that. That's hilarious. I love it. Um, you guys are awesome. You guys are gonna do great. Seriously, I love the engagement that I had today with you. It makes it a lot more fun for me as well, instead of just sitting here and talking for 8 hours. And I know you guys are also going to be really, really good insurance agents. So I can't wait to see y'all's names out there.
Thank you. Go enjoy your parents. Everybody have a lovely weekend. Happy Mommy's
Yes,
Day.
Thank
yes.
you. You guys do the same. Those of you that
All
are
right.
mommy.
All right. Any other questions for me?
Not that I can think of.
No, excellent job. Just excellent.
Yeah.
Okay, perfect. I'm so happy you guys are going to do awesome. I'm going to keep you in my prayers as you guys go through this journey. So you
Thank
guys got
you.
it.
Appreciate that.
You guys got it. All right. See you guys later.
All right.
Thank
Bye-bye,
you.
Bye.
everybody.
Bye.